Hello. Well, thank you all for coming today. Sorry to ruin all the frivolity. I'm delighted, pleased to welcome all of you. This is the second year in a row OMFIF is holding OMFIF seminar on the future of financial stability and monetary policy is being held at the Philadelphia Fed or Reserve Bank. All the proceedings of the next 2 days are going to be live streamed. I want to thank President Harper and his colleagues, the team at the Philadelphia Fed in particular, for being such wonderful colleagues and allowing us to hold this session here. And everybody wants to hear what President Harper has to say, not me. So why don't we just start the proceedings and have some fun?
Sure.
All right.
Is this, there we go. That's good. So first, welcome to the Philly Fed. We're glad you're back, and we're happy to host this event. It's a great conversation we're about to have. I do have to, though, give the standard Fed disclaimer, right? That the views I express today are my own and do not necessarily reflect those of anyone else in the Federal Reserve System or on the Federal Open Market Committee. And translated, you can say Pat said, you can't say the Fed said. That's the rule. So with that, let's just hop in.
You know, I once traveled around with a guy from the SEC, and he would always give the disclaimer, but he added, hey.
You on?
There we go. Is this better? So I traveled around the world with a guy from the SEC, and he would give his disclaimer as you just did, but then he said, and every once in a while they agree with me. So a great honor to ask you a few questions. You're the 11th president and CEO of the Philadelphia Fed, and quite apart from your colleagues on the FOMC, you're an engineer who understands automation and might be able to explain to the FOMC a thing or two about innovation and machine learning. And in your distinguished career, you were inter alia the dean of UPenn's prestigious Wharton School and the president of the University of Delaware, and thus you must undoubtedly be a big Quaker and Blue Hen supporter.
Yep. And we're not the fighting Quakers, we're just Quakers, so that makes no sense.
So whenever an FOMC member is interviewed, the first question is asked for a thumbnail sketch on your outlook for the economy, inflation, labor markets, monetary policy. So let me be very predictable and just sort of
all the above. Yeah, you step back and you look at the economy, it is incredibly resilient. The one thing that I think about is, again, that word resilience, that despite everything we've been through and continue to be through, this economy keeps chugging along. Yes, we have high inflation, and that high inflation is really a scourge, particularly on low to moderate income communities in the country, and we've got to get it under control. We're committed to get it under control. But to do that in a way that does not damage this economy that just keeps moving along. You look at the labor market, and we'll get another read on Friday about the labor market, which will factor into our thinking, my thinking. But, you know, I am not predicting at this point, we're not predicting as a team here in Philadelphia that we'd head into a recession. That's not our modal forecast. It's always a probability, but that is not our modal forecast. So we're looking at, you know, GDP moving over the next couple of years back to its trend growth rate of 2%. But it's going to take some time. Unemployment is going to tick up. It's probably going to tick up, at least in our forecast, over the next year or two, to where we think the long run average is, around 4.4%, say, something like that. And then inflation is going to take some time to come down. But we are seeing signs that it's moving in the right direction. It is stubborn, though. And Some of that is that we still have some supply chain issues. We still have some other issues, particularly labor issues in the economy, but it is moving in the right direction over time. But it's going to take time. And I think we have to recognize that. And so we cannot, try to slam on the brakes really hard, in my view, that we're getting close to a point where we can sit for a little bit in terms of policy. I don't know if we're exactly there yet, but I am in the camp increasingly coming into this meeting of thinking that we really should skip, not pause. I don't like the word pause, but skip an increase. Now, again, I think if we see the labor market data on Friday and then the CPI report come out, that may change my mind. But I think even there, we got to look through one particular FOMC cycle, one particular month. And we've got to get to a point where we have policy in where we believe it's restrictive. And I think we're close, if not at that point right now. And so I think we can take some time. And so I'm not saying that we're not going to continue to tighten. I'll be very clear on this. But I think we can take a bit of a skip for a meeting and frankly get back to, if we're going to go into a period where we need to do more tightening, we can do that every other meeting. We don't have to do it every meeting. I mean, that was kind of the normal pace that we would follow, except in this particularly unusual, what I think the economists called weird economy, that we can take our time. So I am definitely in the camp of thinking about skipping any increase in this meeting, barring what we see in the next few days, and then letting that ride for a little bit and see how we go.
Thank you. A skip, not a pause.
So skip. Because I think it's important that a pause says we're going to hold there for a while. And we may at some point hold at a place for a while, but I don't know that yet. And so I think we have to be ready that we might have to do more in subsequent meetings. And I'm fully aware we have to do that and willing to do that, but I want to give it a little bit of time.
Okay. Well, maybe we can dig down a little bit into some of the things you were talking about and starting off with inflation, because the headlines come down, but the core seems sticky and stubborn, as you said. And I see all these data trimmed to this, ECI, services, sticky, et cetera, core, super core. And I get confused by it all, but I just kind of say, well, inflation seems stuck in the 4 to 5% range, which is far, far away from 2. So you cited a few factors, but what's your assessment of the persistence of inflation, and how do you see it evolving a little more thoroughly?
So it really, at the end of the day, comes down to service inflation, and particularly core service inflation. We're already starting to see the housing inflation come down. It's working through, right? Just mechanically working through the measures. But we're seeing real-time data from Zillow, et cetera, on rents, that they are starting to move in the right direction. So housing seems to be moving, again, to where we'll get to a lower rate. But it's core service inflation that's really driven by labor. And it's a labor issue that is driving that, in my view. We are seeing some signs, and I emphasize some signs, that the labor issue is getting better. When I talk to our contacts and through the survey work we do, it is definitely easier to hire. We're finding it's easier to hire for ourselves at the Fed. It's getting easier to hire IT talent, auditors. You can go down the list. It's just the markets are cooling off. And as a result, when we talk to our contacts, we're not hearing what we were hearing a few years ago, where they're doing mid-year salary increases. They were doing all kinds of other things, buying people gasoline cards, and to get a whole host of things they were doing to try to get people to work. We're just not hearing that right now. It is cooling off. It is sticky though. It's taking some time. I mean, we have long-term demographic trends we can talk about that are holding back labor. We had those before the pandemic. We still have those now. Nothing's really changed there in terms of, other than we, the boomers, accelerated our retirements. But we really had continued long-term labor issues. So some of the factors that are keeping core service inflation up do seem to be abating. There are still some supply chain issues we're hearing about. They're not as severe as they once were, but they're episodic. There's some issues that show up from time to time. But it's not really so much the goods inflation right now that's the driver, right? It's that core service inflation. So that is something I'm watching carefully.
Okay. Services are about 80%.
70,
plus
yeah.
But okay, on labor markets, you said you see signs of slowing, but I was just read that job openings were up in April.
Yeah.
And unemployment is 3.4. So it seems if you have good employment numbers, then you're likely to have decent growth.
Yeah.
So as you said, the economy seems to be performing relative to expectation. There are those that will argue that significant slowing in the labor markets and the economy was needed to cool inflation. I've heard you push back a little bit on this, but can you elaborate on whether you agree, disagree, or why, and how much?
Yeah, so I mean, do we need slowing of the labor market? Yes. That's why we're predicting unemployment going from where it is now to 4.4%. How much, that's back to really long run trend, right? We were, again, below that trend before the pandemic hit. There are these structural issues in our economy, just not enough people, whether that's immigration policy or other policies inhibiting people's ability to work, they were there, they're still there, they haven't gone away. But that's outside the world of monetary policy to address that, right? But they are there. I mean, one of the areas that we're focused on here in the Philly Fed through our community development work is really understanding the child care issue, right? In the state of Delaware, it's $20,000 per kid per year for child care. If you got 3 kids, somebody's staying home, nobody and not going to work. They're working, but not working, right? In what we measure as work. So, I mean, those problems haven't gone away. I do see that we need to cool the labor market, but I don't think we have to crush the labor market to get inflation down. Because the goal is not to dramatically drop inflation right to 2%. It's to move in the right direction and to start to, and we're seeing groceries are starting to get a little better. And some of those, again, those issues have nothing to do with monetary policy. Eggs were about an avian disease, not about monetary policy. So there are those things that are going to hit from time to time. But generally, I think I am in the camp where we don't have to crush the economy to drop inflation dramatically to tomorrow. We can take a little bit of time, get it moving in the right direction. I think we're there. We may need to do more, but we'll let this play out for a little bit before I at least want to support another increase.
Well, that ties into a question that I was going to ask you, because I have seen forecasts next year core goes down to 3% or so. But then some of the analysts argue, well, getting from 3 to 2 is going to be a lot harder than getting from where we were to 3, and that there is going to have to be sacrifice. And others have suggested, well, the Fed shouldn't fall on its sword getting from 3 to 2. It's a bit hypothetical, but people talk about the last mile. How should a data-dependent Fed approach the last mile?
So first, you start with our monetary policy framework, the new framework we put out. So we need to get in the range of 2. We don't need to hit 2, right? And so what that range is, I think each policymaker will make their own judgment of what is close enough. For the sake of argument, let's call it 2.5 to 1.5, right? That's 2. We can argue over what that number is, and we will argue over what that number is exactly. But we need to get in the range of 2. it may be sticky, but you look at some of the trends that, and drivers that might keep it up at 3 instead of 2. Fiscal stimulus. Well, that, I think, I don't see that in the cards in the foreseeable future, right? Given where we are as a country. There is money that is going to be spent on infrastructure and so forth over time, but it is going to be spent at a certain pace, and it just is not going to affect, you know, the homeowners or ability to buy a bigger house or buy, you know, this or that, or to consume more goods or services. So I just don't see that as a driver anymore, fiscal stimulus. So, you know, what's then going to happen? Well, I don't know. I asked myself, we were talking about this earlier, what has fundamentally changed in this economy after the pandemic? I think about that a lot. Again, there's some labor movement. There's a little bit of scarring there. There's going to be scarring around commercial real estate. But generally, what has fundamentally changed from where we were before the pandemic hit? I can't pick up a lot of big things. And so again, go back to where we were. Low inflation, low unemployment. That's where we were. We were struggling to get inflation to 2%, right? We remember those days. Those days are hard to remember sometimes, where we're seeing the devastation that high inflation is causing. But, you know, I just don't see why we couldn't get back to close to that range again. What is structurally so different in this economy that would stop us from getting to that point? The one thing that you would worry about is if inflation expectations get unanchored and then we start a spiral. Again, there's no sign of that right now either. So I think we just need to, it is possible it's going to take time to go, say, from 3 to 2. But as long as we're moving down and getting in the range of 2, I'm fine with that.
Okay, mean reversion, R-start, and all of that. Okay, the Fed's rate hikes have slowed credit growth, perhaps not as much as expected. The senior loan officers review the survey didn't necessarily show abrupt credit tightening. There are worries about commercial real estate vulnerabilities in the economy.
Yeah.
So what's your take on credit? Too hot, too cold? And should we take the view that the latest banking woes, Silicon Valley Bank, First Republic, et cetera, are helping the Fed do its job?
So on the credit is another area where, again, it is going to help us in terms of slowing inflation. What we're hearing from, let's start with what I'm hearing from all the contacts, all the bankers I talked to. It's not a credit crunch, it's a little bit of a credit squeeze, right? Their first reaction, it's natural, is to focus on their existing customers, right? And continue to give them the credit they need for their businesses. That's natural. And really turn away from some new customers. So that's going to create a little bit of a squeeze. I'm not seeing a dramatic credit crunch. I agree with the slew. But I do think that we'll see a little bit of credit contraction, which again will cool things. But on the broader issue of the banking sector, it still remains very strong and resilient. And so again, there are things that are going to happen within the banking sector. There's going to be merger activity. I mean, it's pretty clear that that's going to continue. But I don't think we're going to see anything like we've seen in the past few months.
Okay. Well, let me ask the last question, and then I'll turn to audience questions. But I discussed at the beginning your unique background, and you're in the FOMC as an innovator, an engineer, somebody who understands AI, which makes you a very distinct person. So what insights does that background allow you to bring to the FOMC and that can help them monitor?
So let me ask ChatGPT right now. I'll find out the answer. You know, this technology is going to be quite important, but it's been in development for a long time, right? So I do think that it will have an impact on the economy. Now, there's going to be a big question, right? And this is a question that economists have debated now for a long time. You know, Gordon's book, you know, is it going to be radically change the productivity of the global economy, the US economy? We'll see. I mean, if you believe Gordon, the last big innovation was electricity. And but if you take Eric Brynjolfsson's view, very different perspective, right? That we just don't measure it well. And, you know, Leonard Nakamura and people here at the Philly Fed have done research on this. And, you know, it's important stuff whether we're measuring these things correctly in a very different kind of economy. That said, you know, technology is running. I'm not a Luddite. Maybe it's my background, but I'm not a Luddite. We have to manage technology, but you're not going to stop it, right? And there's ways of managing it. And we can harness this for better use of all of us. But it's not just AI that's coming down the line. For example, we in the Philly Fed here on the AI machine learning front, we've actually invested in our research department and some researchers that are trying to bring machine learning techniques into our economic modeling in a pretty profound way in some ways. That is how my own background of understanding that technology, trying to bring that into a different way of thinking about economics. Because our models, while elegant, are not very predictive, right? And lots of things are going on. And they're not very predictive because it's a very complex system we're trying to model, a highly complex system we're trying to model. But maybe there's better ways of doing that. And that's what we're trying to explore through our research. But there's another technology coming out that is also could be quite revolutionary. It's not just AI. And here's an area where we are also investing here on the part of the system, the overall Federal Reserve System, and that's quantum computing. Quantum computing is within a decade, most likely, of becoming reality. And the machines, the reason I'm interested in this, there's a really twofold reason I'm interested in this, and we as a system are interested in this. First, it's going to change all encryption. All encryption we know has to be replaced. And so quantum safe encryption is going to be something that everybody's going to have to do, and that includes the banks we supervise. They're going to have to put in place a whole different encryption model. And the thing is, the current thinking, at least from the National Institutes of Standards and Technology that we partner with on some of this, is that they don't know exactly what encryption algorithm will work. So you're going to have to be more of a plug and play kind of system of plugging in and out an encryption algorithm. Think about all the systems we run all over the world. All that's going to have to change. But there's also a use for modeling as well. I mean, there may be much better ways of doing Monte Carlo simulation with a quantum computer, much faster. So we can do much more detailed and precise stress test modeling, multivariate stress test modeling. There's a host of things that we can think about. And so we're actually starting to explore those too, with a little bit of a sandbox in the Fed to just explore how that technology can be used. But it is one that is absolutely coming at us. But back to AI, let me finish on that. And I want to go back to Eric Brynjolfsson and his book. He wrote a book back in 2014 with McAfee that was called The Second Machine Age. This is a while ago, right? And they make the point in that book at one point, they talk about productivity and technology, so forth. They make the point that there's still a role for human beings. We're not going to be the Borg on, Star Trek. That really hard. There's still skills that we have that are uniquely human, that technology is going to have a hard time replicating. And they articulate those in this book. It's 10 years later, technology's changed. But what we need to do is double down on those things that humans do uniquely well. And I put my old educator hat on, and that's what we need to do in the education system. We need to really double down on that kind of complex thinking, that kind of very human forms of communication and leadership. Rote stuff that you can look up, well, those days are gone. right? But we need to change, we really need to change the way the young people who are being educated think, and think in a much more complex way, and aided by these tools, these AI tools. And we shouldn't be afraid of it. We should embrace that and be willing to embrace that change. That's going to be hard. Like the education system isn't all, particularly higher education system where I come from, is not always amenable to that. But it is something we're absolutely going to have to do, because you're not going, once we start using these tools, we're not going to.
Thank you for that. I can see in your citation books and your discourse on that subject, it's a true passion of yours.
Yeah. Yeah. I mean, this stuff is coming, and we need to figure out how to use it, in the case of the Fed, to help us do our job, right? To just create a more stable economy. And I think there's some tools there that we can use that could be efficacious.
Maybe we'll figure out an algorithm that'll tell us what the Fed funds rate will be.
Yeah.
Any questions from the audience? Let's see how many. One. My goodness. All right.
Now we're being live streamed, so please use the mic when you ask the question.
Absolutely. And I frequently just take 3 at a time. I don't know how much time you have. So I'm going to start this way and go this way. So did you?
Yeah.
Please.
President Harker, thank you for your comments. I was curious to hear your thoughts on the neutral rate, given what you just said about productivity, but counterbalancing it earlier with your thought that nothing has really changed pre-COVID. So where do you think the neutral rate is, and do you think that it is in any way, shape, or form different than where it was in the past? Thank you.
That's the first one. Let's keep going down this way. Everybody, over to Dave.
Hi. So my question was more around what happened with some of the regional bank collapses, and one can say that was a result of some monetary policy changes. But how does the Fed think about some of the other large institutions, given that the cost of funding is going up, deposits are leaving, and do you view that as a concern in terms of the lending that's going on in the market, be it small, medium-sized lending or commercial lending, where they're probably some of the biggest providers to some of those local markets?
Great question, David. You're the end of this first. Actually, David.
All right. Sorry, it will be your turn very soon, I'm sure. I was wondering from a market perspective, we've seen a lot of volatility in terms of what is priced. So the 2-year U.S. Treasury yield has been kind of all over the place, going 10, 20 basis points up and down, and there has been a bit of criticism by some that the Fed has kind of fueled some of that volatility, which from a real economy point of view probably isn't very healthy or helpful. Would you view that as just an inevitable kind of thing in this current situation, or is there an argument to make that yes, maybe communication could be improved in some areas?
Okay, so
First one was neutral.
yeah,
rate.
so on the neutral rate, it could change, but often the best predictor is what happened in the past. We see this with inflation, and so I don't know. I mean, that the jury is really out on that. So, but if it changes, it's going to change over decades, not over a couple of years or a year. I mean, this technology takes a long time to filter through. You look at any technology adoption S-curve, you're talking 20+ years. So on the banking crisis, Vice Chair Barr has released a report. We need to understand what happened, whether has to be some changes in how we look at things like regulatory capital and what's in and what's out. That's obviously in the hands of the Board of Governors, not in the regional banks. There is pressure under the regional banks. I'm a little concerned right now that if, knock on wood, we get this debt ceiling crisis behind us, Treasury will be issuing, there is going to be some potential, and I emphasize potential, movement of liquidity out of the banking system. And how much we don't know, but it's something that we have to be very careful on. And the last question, on volatility, I think the best thing we can do at the Fed is to try to create stability in our policy. And that's why I'm in the camp of getting up to a point that is clearly restrictive and holding for a while. I'm willing to skip here if we're not at that point, but at some point we got to just sit for a while and let things work. And so we shouldn't be adding to that volatility in my mind. We should just have stability at a rate, let things go for a while, let the data evolve, let the economy, let the inflation cool. And at some point in the future, and we're not predicting this year, by the way, we start to bring rates down. I think we just need to hold. So I don't want to add to that instability.
Okay, let's take three more. So I see two flags up. Any others? David?
Yes, you seem to be outlining a move to what you might call a kinder, gentler Fed. How much of this would you say is down to paying some regard to social consequences of higher interest rates? You mentioned you don't want to crush the labor market. And then you didn't mention the war in Ukraine. Is this slightly more compliant attitude, a slightly more patient attitude, also perhaps a reflection of the fractured world system? You don't want to pour oil on troubled waters. And in the light of all that, would you have anything against what I call the 3-4 syndrome, which is to have inflation of 3 to 4% over the next 3 to 4 years? What's wrong with that?
Patricia?
I just wanted to come back to your points about all these new tools and technologies, from AI to quantum computing. A lot of innovation is going on in the financial sector and also outside the financial sector with regard to financial services. And one of the biggest challenges for those participating is to understand what is permissible and what is not. And right now, there's not a lot of clarity in the regulatory world around some of these newer asset classes like digital assets. So I'm just curious how you reconcile the support of innovation while regulating, new frontiers and new products.
George, you get the last question.
One of the salient aspects of this expansion is the very high ratio of job openings to unemployment. And I'm just wondering how we should think about that in equilibrium. What is sort of an equilibrium position for that?
And can I pile on David's question? Touch the main issue. If you had any thoughts for us on this discussion that we see internationally about fragmentation and the economic costs for the United States.
So the particular issue of Ukraine, this incredible tragedy, the horrific stuff that's going on, it adds just to the volatility that we're facing in the markets, because we don't know, there could be a worst case scenario. God forbid the worst case scenario that happens there. So yeah, it's adding to people's angst, and that angst gets reflected right in the broad volatility that we see. 3-4%. One thing that I kind of learned in 8 years here at the Fed is you got to look beyond the headline inflation number and look at what exactly we're talking about, right? So you could say, well, we could live with 3%, that's fine. But if that means food, shelter, and energy costs are really high, that crushes the low income to moderate income communities. So could you live with that? Well, if it would, I'm not in that camp. I think we do need to get down to 2%. That is our commitment, and that's what we need to do. But even if you wanted to be in that camp, you'd have to really look at the components of that. Because if it really is, if people can't find a place to live and they can't drive to work, and we just did interviews of what we're calling the Worker Voices Project. where we actually listen to workers and why they're not going to work. And that's, I want to come back to that. And one of the things one guy said is, yeah, I mean, it costs me 2 hours of wages to drive to and from work. In 2 hours, that's the way he translates it, right? 2 hours of wages every day to drive to and from work. That's killing me. So it really depends, I think, on what those components are. On the new technologies and innovation in financial services, we shouldn't stop that innovation, but there has to be a regulatory framework. And that regulatory framework at the end of the day doesn't come from the Fed. It's got to come from Congress, right? I mean, because it's not clear. You know, we do a big fintech conference every year here. And it's not clear who's in charge of different things, because it's not just, you know, digital assets. It's what type of digital asset it is and who would regulate it, and whether it's a stable coin that looks a lot like a money market fund, and that would fall in the SEC. That's not our decision to make. That's really ultimately Congress's decision to make. And I hope they do it soon to clarify some of what we're seeing, because it is causing some confusion. Last, the openings. Why are we having these openings? Well, there's a couple things. One is we do have, overall, if you just look at the macro issue, we have just boomers retiring. We've got a generation coming in that is smaller. We don't have an immigration policy. And again, I'm going to triple down on my disclaimer. It's not my job to tell somebody what the immigration policy is, but we don't have an immigration policy really. You know, so there's, in this, you listen to the Chamber of Commerce, you listen to every business leader, they're just pleading for clarity around this, right? Pleading. I had a guy who last summer, a landscaper I heard about in the central part of the state here in Pennsylvania, he had these workers coming on temporary visas, but they got there late. They got a couple months late. And so he was putting down mulch in August on people's yards here, and they were complaining. By that point, the weeds have all grown, and I don't need the mulch anymore. He couldn't get the workers. So the immigration policy, not even for permanent residents, but just temporary work visas, we've got a real problem. We've got to back, the systems are antiquated, and we've got to solve this problem. But that leads then to the last point I'll make, and why we did this Worker Voices project that we just issued this report. It was a system-wide effort that was really led out of Philadelphia. You know, employers couldn't understand why they're not getting the workers. So what we did is go ask the workers. We asked across about, I think it was 33 states, 147 zip codes, people who were in work training programs or affiliated work training programs, what was going on? Why weren't they taking the jobs? Why they were not working, but they wanted to work. You know, and some of them wanted to upskill. They didn't, you know, they didn't want the job they had. And frankly, the pandemic gave them a little bit of breathing space to get the skills necessary. That's why they're going back to workforce training programs to get a better job. But one word, because I met with a group here that came after the report was done, we wanted to bounce off of them what the findings were to get their reaction. And the one word I heard, whether it was directly articulated or indirectly articulated, was dignity. It's not wages. Wages are part of it. Now, yes, employers is wages, but you ask the workers. And there was one woman there in particular, she said, I have 2 kids. I don't know what my schedule is, you know, day to day. I can't do this. I've got 2 kids. I need to have some stability in what my schedule is. And my boss just doesn't get it. And this is consistent with what you know about labor markets and management of human resources. That after wages, the number 1 reason people leave a job is their manager. Their manager. Though they're often willing to take a lower paid job to get a better boss who understands what they're going through. And remember who we're talking about, low-wage workers, these service workers. That's where the service inflation is. These are people who are working 2, 3 jobs, and they just want some stability and some understanding, childcare being part of that. I mean, there's a whole host of reasons. So, yeah, we got a lot of openings, but we had tight labor markets before. Again, these were problems that weren't new to the pandemic. They were just accelerated or exacerbated by the pandemic. Those are the things way outside of monetary policy. It's not just about wages. You can increase the wages, but if somebody still can't get somebody to take care of their kids, what does it matter, right? It's not going to move the needle at all, because the cost of childcare just went up, because the wages went up, inflation went up. So this is why we got to get inflation under control. Part of this is getting inflation under control, get these other policies outside of monetary policy right. Because ultimately, let's face it, it's a supply-demand issue. We can affect demand of labor, but the supply of labor is also important. And it's something that we need to address societally, not just in, it's not in the wheelhouse of the Federal Reserve to do that. It really is in the wheelhouse of Congress, local governments all across the country, coming up with creative solutions to solve these problems.
Fantastic. Well, thank you for spending
Thank you.
so
And
much
thank you for
time.
coming to Philadelphia.
A huge round of applause for President Harker. Shall we start the macro panel? Okay.
They should all have microphones at the chair.
You guys all have mics? I'm planning, if you guys are doing well, to keep you going for the whole hour and then just delay the whole thing today. So I can learn from your wisdom. Okay. Well, let's see how we're doing. We'll see. Oh, yeah. Okay. Delighted to be joined by this panel. For this panel, we have Chiara Scotti, Senior Vice President and Director of Research at the Dallas Fed. Before joining the Dallas Fed in 2023, she worked at the Fed board as a special advisor to former Vice Chair Rich Clarida and in the Financial Stability Division, as well as in the International Financial Division. A longtime colleague, Joe Gruber, since 2020, the Executive Vice President and Director of Research at the Kansas City Fed. Before that, he was Deputy Director of the Fed Board's International Finance Division, a special advisor to Stan Fisher and Randy Quarles, and he even once put in a stint at the U.S. office in the IMF, where he suffered as a Fed person through the indignity of working with Treasury officials. Kartik Athreya, Executive Vice President and Director of Research at the Federal Reserve Bank of Richmond. So welcome. For the first half, I plan to put questions to them and then open it up to the audience. I'm going to try 2 rounds. For round 1, Joe, Kartik, and Chiara, just to ask you about your overall take on the U.S. macro situation and maybe any of the points that I raised with President Harker that intrigued you. And in this regard, perhaps you could give us a bit of the description of conditions in the regions you represent and any insights thus gleaned for the overall health of the U.S. economy and any thoughts on how that plays into soft, hard landing debates and whatnot. Joe.
Thanks, Mark. Thanks for having me here, and to my other panelists. I mean, it's great to be here and be able to participate in this event. Yeah, the Treasury official that I got to work with, of course, was Mark, who was my boss in the USEB's office. So
3 months. You couldn't take it any longer.
yeah, exactly. Well, I guess we only did that for 3 months. Yeah, so I'll just pick up on some of the remarks that President Harker had there. I don't think I have a fundamentally different view of the economy, but I'll also talk a bit to the Kansas City region, there are some interesting things that are going on there, I think, relative to the rest of the country too. So, the context for the discussion, though, of course, is that inflation remains too high. I don't think that would be surprising to anyone. Headline inflation running around 4.5%. Of course, we're down from the 7% that we hit in June of last year. Right, but a lot of that has to do with energy prices. If you look at core prices, they've been considerably more persistent and actually higher than headline at this point. So a lot of persistence in inflation ongoing. So if we look at the fundamental, what's going on with inflation, I think that we're still in a world of imbalances, right? And imbalances have been an important description basically for inflation of the past 2 years. We're in a situation where robust demand is outstripping the ability of the economy to supply goods and services. And I think that's what we're still seeing. Of course, you might think, oh, well, prices going up, that always reflects an imbalance in the economy. But of course, that's not true. As President Harker said, there's another type of inflation that rooted in inflation expectations being unanchored. In some ways, I would view that as a worse situation, right? That's the type of inflation situation we want to stay out of. Currently, we have inflation, but that's due to the tightness of the economy. Very tight labor market, very tight product markets, and so on. In some sense, I would say that's compared to the alternatives, I think it's something that we can address. Looking at those imbalances, right? I mean, demand, the robustness of demand, I don't think is surprising. Unemployment rate's very low, wage gains are high. We had a tremendous transfer and balance sheet capacity, basically, from the government to the private sector through the pandemic. And I think that is still pretty much the underlying factor for why demand is so strong, right? Household balance sheets were well improved. Net wealth of the household sector climbed a lot, and we're continuing to see that money spent out. So demand is very strong. One thing that's been surprising to me, looking into the details of demand and looking through individual PCE categories, is that you saw a real step up in certain categories that you would relate directly to the pandemic. So, getting into the weeds, one in particular would be musical instruments, right? So it took 20 years for musical instruments to increase from $5 billion to $7 billion in the annual rate. And then it took just a few months for that to jump up an additional $1 billion to $7 billion. Right? So everyone bought their electric guitar for their pandemic and they learned how to play. Now, the interesting thing to me is that it hasn't come down, right? I mean, there's actually been no retracement. So it jumped up to 7 billion and stayed there. So none of that has actually reversed. From my personal experience, right, with family of 4, we went from a very reasonable 4-bike household before the pandemic to 8 bikes and climbing at this point, and pretty much garage destroying number of bikes. So there's all this pandemic consumption that hasn't come up, right? And I think that that's pretty remarkable. So it's not just a one-time blip, really, but that this demand's been persistent and continues to be robust. So against that, of course, supply side just hasn't been able to keep up. A lot of that was pandemic related. There's a bit of a cottage industry now, looking at the mistakes in inflation forecasts and trying to attribute that to either underestimation of demand or an underestimation of supply. IMF has a nice paper that came out on this recently, and then of course Bernanke and Blanchard just had a paper last week that kind of does this decomposition too. When I look at it, and this is again, I guess I should start with the disclaimer that even more so than President Harker, these are my own views, not the views of anyone the Fed system or anyone else at this point. But when I look at the mistakes on inflation, why inflation wasn't there, it's not just the pandemic impacts on supply, but really the underlying structural pace of supply growth, which I think has been pretty disappointing, right? And so I was here last year and I kind of laid out a similar trajectory, and actually this mimics remarks I gave at the Peterson Institute in April of 2021. That when you have a tremendous amount of liquidity added to an economy, and you think that over time those ratios are going to normalize, how does the system absorb all that liquidity? There's really 3 mechanisms, right? Either people are going to hold more liquidity, and I mean, that would have been perfectly reasonable coming out of the shock of the pandemic, that people want to be more liquid, right? So that wouldn't surprise me. The other thing is that growth could increase, so you could have an increase in GP that would normalize those ratios. And then, of course, the third one is the prices go up, right? So I guess when I looked at all the demand stimulus that was injected in the economy during the pandemic, my assumption was that we were going to see a little bit more on the GDP side, that we'd actually see more of an increase in growth. Part of the mindset there, I think, is going into the pandemic, we've gone through a decade where the macroeconomic discussion is really dominated with the idea of secular stagnation, right? This idea that demand growth was the problem that higher demand growth, stronger demand growth would actually bring forth higher supply. And so I think we dumped a lot. I mean, a lot of stimulus was out to the economy during the pandemic. And the idea was that, well, we've gone through this demand deficit for so long that the supply would be there. But, supply really hasn't stepped up. I mean, if you look over if I go back to pre-pandemic and I go through the downs and ups, growth has averaged about 2% over this entire period. If you go back the decade before the pandemic, it's been about 2%, right? So we're not really seeing any big increase in GDP. Even more remarkable to me is if you look at manufacturing IP, real IP, right? Real manufacturing IP, it's indexed 100 in 2017. If you go back to 2012, it's 100. It fluctuates within 1 percentage point band throughout the entire period. Sure, we had a dip during the pandemic. In April, following a tremendous amount of stimulus, one of the largest increases in relative price of goods relative to services that we've seen, trade policy developments, and the index is at 100.3, right? So really no growth in the manufacturing sector, even as we're seeing this historic jump basically in goods demand, a lot of policy-driven developments, and certainly read about individual developments in the manufacturing sector, but overall it's been very flat sector, and very unresponsive to changes in prices, which is troubling as an economist because prices are the signal that basically lead to economic outcomes, and really in this sector it's been pretty negative. So I think that my takeaway really is that there needs to be more focus on supply side. Jackson Hole last year, sponsored by the Kansas City Fed, the theme of the conference was basically reassessing constraints on the economy, and I think Augustine Carstens gave a really interesting speech from the BIS, kind of making the same point that I'm making here, is that maybe, we've gotten kind of tied up in the world of demand management, but really we need to refocus and kind of think more about the structural barriers on growth, structural barriers on the supply side, and not necessarily get distracted by the demand side the whole time. Now, this goes back to me and Mark, right? Because through the middle of the decade, when we were working together at the IMF, I thought we put together what I remember as being tremendously eloquent speeches basically on the need for more demand stimulus from our foreign partners, right? And not so much focus on structural growth. I'm just wondering if we got the story wrong in some sense, and that maybe there's more of a structural factor there than we admitted at the time when we were making those speeches.
Well, that's a discussion for another day. When I see 7% of GDP current account surpluses, I can't think anything other than the distribution of global demand is a bit off kilter. Joe, can I ask you a question for 30 seconds? I'll give you a minute max. Anything you wish to say about Kansas City region and the economy there that sheds insight?
I mean, one thing that's really interesting in our region, and I mean, it's true, I think, in all three of our regions, but ag gets a lot of the discussion. We actually had an agricultural symposium last week that brought in a lot of ag producers from around the region. And, I mean, hearing that discussion has always been very interesting to me. I think that even now in this circumstance, farmers, I would say, are cautiously optimistic, which actually, I think if you look across the spectrum of, attitudes in farmers, cautiously optimistic is basically the max. They never get to giddily optimistic because that's just never where a farmer's going to be given the stochastic shocks that they suffer. But even now, with commodity prices relatively high, farm incomes are really strong. I mean, it's a sector of the economy that keeps on going. And I think that it's been interesting getting those views from that sector.
Great. Kartik.
I'm going to issue the same disclaimer. These are my views. And I'm actually going to try hard to speak really from the vantage of an advisor to a policymaker, and that's the president of the Richmond Fed. So I will try to be an economist more than anything else in what I say. So starting, Mark, with the question about the district, the Richmond District tends overall to be fairly representative of the US economy. It's big, it's diversified, and so on. It is true that in the most recent manufacturing and non-manufacturing surveys that we run, that we are starting to see what may look like a slowing of overall economic activity, not particularly stark yet at all. And I think that dovetails with the things that we've heard so far, especially from Pat before, on the economy as a whole is sort of rolling along right now. And you do have to squint a little bit to see really appreciable slowing. I think, Mark, you asked earlier on about the labor market and the scale of vacancies. One silver lining, if you want to call it that, is the moves in vacancies have happened in a way that have held the unemployment rate essentially static at an extraordinarily low rate. So if you want to think about a bright, relatively bright pathway to an economy that has inflation back at target without necessarily having a particularly sharp cessation of activity or a drawdown of activity, that is a data point that I take some signal from, that perhaps we are walking down in an orderly fashion to something that looks more normalized. To build on something Pat said earlier, I think one way that I frame it in my own mind is that when we see activity happening the way we have, and when we see prices moving the way we have, it's a sign in some sense that it is monetary policy that is needed, that's on its way to being normalized. That's why we talk about demand the way we've been talking about it. Obviously, the systems leadership moved in that direction very decisively a year ago, and we're going to see if that proves sufficient or not. And I'll leave it to Pat and his colleagues to make those calls. One other thing that I just wanted to point out is that I think Joe's point is right, that on some level, we do always want to think about supply. I mean, for an economist in any long run setting, that's the only thing that matters anyway. If you're going to if you care about your grandkids and you get to choose between 1% and 2% growth, that beats doing anything else, easily. So yeah, supply side should never be kind of far from our minds, but that said, I also have the view that the way we navigated the pandemic at a macroscopic level, I think it's very easy for people like me who are in high frequency macro discussions to get distracted actually by thinking about the oncoming torrent of data of this thing went up, this thing went down, this thing went up by 18 basis points, whatever. The big picture is that the economy navigated extraordinarily well at a macro level, something that was just beyond most people's cognition as something that could actually happen. If you were to say, this is what will happen in the event of a pandemic, about 1 million people will die. Here's what I'm going to show you a picture of GDP. I'm going to show you consumption. I'm going to show you services consumption, and I'm going to show you inflation. You'd have to look at it a little bit and think, okay, maybe this was overall an economy that responded well to the reality in which it was operating. So in that sense, I do think there's something about, we learned something about the resiliency of the US macro economy with all the policy apparatus that was aimed at it during this event, that I take away from me as useful, heading onward. So let me stop there.
Chiara.
So thinking about what else I can add that is new. So let me first say the usual disclaimer applies. So I'm not going to comment a lot on the national economy, given that we already heard quite a bit. The only, piece of publicity that I'm going to put in there is that, yes, the economy is resilient. And one way that we can look at it is by using this index that the Philadelphia Fed is publishing since like 2008, which is called the ADS index. I'm DS. I tend to, to pay attention when I look at the economy. Is a real-time index of how things are going in the economy. As of today, it's still telling us that the economy is sort of sailing through. So just wanted to mention that, for the national economy. I think the rest the other things that I want to talk about are really related to my district, the 11th district, which is sort of a peculiar district because we actually benefit from immigration and, from the resources in terms of energy that we have. And so I have to say that, we are a little bit different maybe from some other parts of the United States. But what we are seeing is, pretty much what you see at the national level. The pieces of information that I would like to talk to you about today, yes, they refer to inflation, to labor market, to the economy in the district in general. And I'm going to do it through the lens of a couple of surveys that we have. One is the TPOS, which is our Texas Business Outlook survey. Those surveys have actually been released in the past couple of days. They give information about labor market, inflation. And so I think that something that I've been paying quite a bit of attention to is really the responses regarding some of the questions that we ask related to inflation. So for example, we ask a question which is related to the primary drivers of inflation. It's interesting to see that, among the list of drivers, higher import and labor costs are still, the major drivers that people are citing. And another interesting question that we ask is about expectations for price and wage growth. And what we find is that firm anticipates a 4.7 increase in input prices and a 5.3 increase in wages for this year, with selling prices expected to rise by 3.8% on average, which, is giving them some indication that things are still kind of hot. If we look at the labor market, we get, from the T-Boss some sort of similar information to what we are seeing in the national economy. And so, the labor market is still tight. We are starting to see signs of workers' availability. And so in particular, among those respondents looking to hire in our T-Boss survey, they actually noted improved applicant availability in April compared to January when we asked this question the other time. At the same time, improvements in wages, in wage measures has been slow. So again, very similar to what we've seen. The other pieces of information that I wanted to bring here is more related to credit availability. They touched upon this. We have our own banking conditions survey, which is released 8 times a year. So 4 more times than the SLU survey that you guys, I'm sure, are very familiar with. And, both in April and in May, we saw, increased tightening. However, the interesting part is that this is really like the respondents actually said that the major reason for this is really monetary policy tightening rather than the banking stress that we've been observing over the past couple of months.
Thank you. Let me get on to a second round of questioning, which is more specific. So let me start with Kartik. You've written quite a bit about U.S. housing markets and financial distress. I think that's really your bread and butter in many respects. So obviously, economic slowdowns, contractions impact housing, and that's a main channel for slowing momentum in the economy. And rising rates cause distress. But one also hears that household balance sheets are strong in America. Maybe that's distributionally not the case in every quintile. But and then we also read about commercial residential real estate issues. So can you comment on these topics, including what they might portend or not for credit contraction or crunch or whatever? Squeeze, that was the term Patrick used.
Yeah, sure. I do want to open by, I think, arguing that right now, to the extent that credit is being squeezed or crunched or pressed or somehow crimped in its style, it's not that easy to see. So right now is not a moment when it looks like that is going to be by itself something that, at least in my view, again, that is likely to sit heavily on the performance of the macroeconomy going forward. Now going back to sort of things that, Mark, you just brought up, it is absolutely true that one of the reasons I think that we navigated the pandemic the way we did was the change in support from the policy side, both monetary, of course, and fiscal as well, that gave rise to the liquidity that, Joe, you talked about earlier. That was very unevenly distributed. It has been drawn down relatively differently across the quintiles. The Board of Governors has a website that actually has a really nice description of kind of a measure of excess savings that they compute and that I think you might find useful to look at. one dimension of that is that it is true now that we're getting a group towards the, fairly plausibly, the group that is often in the most dire straits financially, running through a lot of that, simply because that's a group that ends up spending more of their income as it comes in. One of the bigger picture things that has become clear to me through my own research, as well as reading that of others, is that economists' estimate of the fraction of the population that is closer to hand to mouth in the sense of spending fairly rapidly, I think has been revised upward. It's certainly been revised upward in my own view since I started thinking about things. There's a famous paper called The Wealthy Hand to Mouth, if some of you have seen that paper. That changed my view a little bit about the extent to which even those further up the wealth distribution, who own homes typically, are also reliably characterized as being very sensitive to cash flow, which is not something you might have thought up front, given the ability, at least in principle, it looks like, to liquefy one's wealth to finance consumption. So that's been an area of upward revision in the fraction of households who are kind of relatively beholden to moves in cash flow. So as the stimulus related funding has been spent, as it's being dissipated, there would have been, in my mind, I would say all else equal, this could portend a more significant slowdown in aggregate consumption as we go forward. That having been said, it's not that easy to see in the data quite yet, and services consumption tends to be fairly smooth. Of all the things, consumption is smooth, services consumption really smooth, relatively speaking. And so in one way, you can view this drawdown of fiscal transfers happening. At the same time, that one doesn't have to become particularly alarmist about the path ahead. In particular, one of the things that we haven't seen that much of, even now, having exited the pandemic for a while, a really sharp rise in delinquencies in consumer credit. We haven't seen it there. Housing hasn't slowed down in the way that if you had asked me personally a year ago, said you guys are going to, the Fed is going to move policy rates up by roughly 500 basis points. What do you think is going to happen? I'd probably not have said, I'll be fully transparent, not have said this is what I would be observing in housing either. So that resilience, to me, I think looks like a big deal when combined with the overall strength of demand and then the move downward really in vacancies on the labor market side rather than in unemployment. The micro level uncertainty in which people are operating right now, aside from inflation, I don't think has gone in the direction of portending a lot of trouble at this moment.
Okay. I'm going to save Chiara as the best for last, the cleanup hitter. Joe, so you've written recently, I think, about Fed communications. So maybe you can share with us the main results of your work. And more generally, what are your thoughts about whether forward guidance has been a good tool and how to think about it at a time when everybody's quite uncertain about the outlook and emphasizing data dependency?
No, thanks, Mark. Yeah, so this is an opportunity, I guess, to plug some of the more recent research that I've done basically on Fed communications. Now, I always view every piece of Fed communication really coming from policymakers, not from us, is often dissected by the market basically for information on the reaction function. So I think that's the primary thing that people are looking for, is they're trying to discern basically what the reaction function is from a lot of these communications. And so the communications do have policy impact. And I think one of the things that I'm aware of is people go back and they kind of retrospectively look at some of the communications. Often they're basically being judged on terms of forecast accuracy, kind of removed from the policy implications of the communications at the time in the policy context. And so I was kind of interested in this question. And so we did some work looking basically at the state-based forward guidance that was introduced in 2012. And really how the introduction of that guidance kind of changed the way that Fed policymakers were discussing the outlook. And so that it's not just about revealing information on the economy, but basically in the way that the policymakers talked about the economy, there was actually kind of a subtle shift around that time, right? And so the 2012 guidance was really in terms of an unemployment rate that, would be hit before policy rates were to rise. Shortly after it was introduced, though, unemployment rate started to move towards that target relatively rapidly. And there was a kind of a switch in the tone of communications. And so we do textual analysis across a wide variety of speeches, public speeches, and statements. And it turns out, policymakers started to talk about the outlook a little bit more negatively given the underlying factors after the guidance was introduced, right? In some sense, there is a shift towards looking at other measures of the labor market and not just unemployment at that point, right? And probably, a degree basically that very much aware, well, again, I can't put thoughts in anyone's mind, but there was this kind of shifting tone around foreign guidance. So I think there is, there's this element in which there's this interaction basically between foreign guidance and how people look at the data. Maybe not even explicitly, but just in the way that they're internalizing the data. I think that's an important aspect of thinking about that communication. Just leave it at that.
Okay, Kiara, I know you have thoughts on forward guidance as well, so I'm going to ask you to amplify on that. And I have a simple question for you. It's about the so-called separation principles, since I noticed you worked in the Fed's financial stability. I figure this is a fair game question. So it seems to me that if there's a credit contraction, that can raise financial stability risks, and that financial stability problems can impact the macro situation and the attainment of the dual mandate. Plus, in my view, the Financial Stability Oversight Council hasn't proven to be a strong outfit. And as we saw with Silicon Valley Bank, supervisory failures can cause problems, and frankly, non-bank financial intermediation can cause problems. So I guess my question is, I have some skepticism about the separation principle and how it works in practice, not in theory. I get the theory, but what are your thoughts on this issue?
I think I could speak until tomorrow about both things. So stop me when I've said enough. But I wanted to continue a little bit the conversation about forward guidance simply because, and communication, Fed communication in general, because I've actually done quite a bit of research on that. And so I wanted to share a couple of thoughts. So the first one about forward guidance, I think that it has been established in the literature, both theoretical literature and empirical literature, that it was effective. It's been effective. Clearly, all the studies that have been done so far were mainly done at the ELB, at the effective lower bound, because this is what we were going through when we started to implement, to really take forward guidance to the next level with Chair Bernanke. And this is also what I find in my own research. I think we are in a slightly different situation now because, we are not at the effective lower bound. And so there are a lot more issues that we need to consider. So the main reason why we were using forward guidance was really to get, the extra mile on the staying low for long. We're now in a different situation that we're really watching the data. And so I think that, it's really important to continue to be transparent, but the benefits for, forward guidance, they still need to be assessed, at least in my personal research. I'm still working on that, just making sure that I get more data before I can tell you what the results are. The other additional thing that I want to talk about is, again, related to communication, not really related about specifically forward guidance, but about Fed communication. This is a super recent working paper, and we try to understand how monetary policy communication flows through the pipes. So monetary policy echoes, through looking at the statement, and then how it is read and reinterpreted through newspapers and Twitter. I can go on and tell you more about that, but I think it's a very interesting way of looking at things. And I think the one thing that I think is very important is to try to understand what is it that journalists or people who write on Twitter see differently from the Fed, because they actually interpret sometimes the statement in a different way. And there are three possibilities. One is, that they see different data. The other one is that they have a different monetary policy function. And then the last one is that they actually have a different perception of the signal. And so I'm not going to give you the answer so that you have to go and look for my paper. So, but let me turn to your question on financial stability, the separation principle. I see what, where you're coming from. I think there is an important distinction that we need to make, which is, separation and independence, because while the objectives can be different, of the different tools can be different, sometimes, the effects are not completely independent. And so to me, a better question related to this issue is to try and understand what are the conditions of whether when there are or there are not benefits, from using different tools. And so, there are situations like during the pandemic in which it really didn't matter because, of course, the tools were going, in the same directions. But then there are situations like we saw, in the UK in the fall, and then with the banking stress when things are moving different ways. And so monetary policy tools are trying to achieve something, and financial stability tools are trying to achieve something else. And so it is really important to, keep those tools separate in those particular situations. And I think that, it's really important to communicate, just to go back to the Fed communication, to communicate clearly that the tools are acting, with different purposes. I can go on, but I think I'll stop here. Could potentially continue talking about some of the other issues, but.
Good. So I have a phone ringing. I can't turn it off right now. I'm going to turn to the audience for questions. So if everybody can put up their flags, they have questions. And Mr. March is going to start us off.
Well, thank you, Chiara, for mentioning the UK episode of the last fall. I just wanted to bring that one up because it does seem to serve quite a useful purpose in lots of ways. It sharpened people's minds about what happens when, as you say, you have two sets of events that seem to be going in different directions. So the Bank of England did have to do a temporary reversal, it seemed, of the tightening that they were trying to do. There's also, of course, in Europe, there's this famous thing called the Transmission Protection Instrument, which I'm sure you're very well up on. It's still a bit murky, but I wonder whether you would like to draw on the European experience as well, where it might be that at some stage in the future, Europe would have to bring about this special tool if the spreads were to be widening too much in a place like Italy, for example. Do you, from your vantage point at Dulles, do you have any lessons that you might like to give to the European Central Bank about how such a tool might be deployed? I'm sure they could use the bits of advice very nicely.
Isn't it fun when you're an official and you get questions like that are dicey? So go ahead.
I'm just banking on your international background, Chiara.
My international background, actually, the two of us started in international finance at the board. So, if you're referring to that part of my international background, yes. I think that it is not my role to comment on what the European Central Bank should do. I think that what I can tell you is, we have these couple of experiences in the UK and in the US about how, the two central banks decided to intervene. And I think that the playbook worked out quite well. And so if anything, my idea is always, look at what worked and what didn't work and learn from that.
Maybe you just need a bit of luck as well. That can help.
I have a feeling Kartik and Joe don't want to touch that question. Are there other questions around, or should I continue pummeling them? Please. Could you identify yourself? There we go. Need the mic as well. Yeah.
Can each of you talk about what risks do you see to the outlook for the US economy at this particular moment? Thank you.
Start with Kartik. I like your socks, by the way.
Thank you. Yeah, as far as risks, I think, first of all, the speed of the normalization was relatively, quick by, relative to a bunch of history of the Fed, not all of it. So I think it would be reasonable for me to think, okay, that's one possible place in which we'll have to be careful, or we'll have to watch and see how things evolve. It's not my place, of course, to comment on what I particularly think, but the geopolitical environment looks unusually fluid to me. In the longer run, I think I'm glad that, Mark, you ended up talking to Pat about things like AI and so on, because again, in the spirit of things that are moving more quickly than I anticipated or that I thought they would, that seems to be one more of those things. So, in a year from now, maybe that's the thing that's going to be really front and center. I don't know, but those are.
Chiara?
I completely agree with what Kartik said. I mean, I think that in general, there is the risk that, we are, inflation, continues to be highly persistent. At the same time, there is the risk that, the economy might not continue to be as strong. And I think that is a very fine line that, the policymakers are trying to navigate, considering everything that, we've been discussing today about the economy.
Yeah, I mean, I'll follow up on both of those in particular. I mean, persistence of inflation, I think, is a notable risk. Some of the things that people will talk about a lot is like housing inflation. I think there's an assumption that it will come down. Some of the work that we've done at Kansas City shows, housing inflation is actually importantly determined or influenced basically by the tightness of the labor market. And so you might not draw that connection directly from wages, but in a tight labor market, people do want to upsize the size of their dwelling prices. So it's something that we're keeping an eye on. To follow up on some of the conversation earlier today, I think another interesting question basically is about the neutral rate. And I think we got the question about the neutral rate and where things are going to go. And to piggyback on President Harker's remarks, a lot of that are slow-moving things that we wouldn't necessarily expect to change. I mean, a lot of the stories we saw pre-pandemic, productivity growth, demographics, I don't really expect that we're going to see much action on those. However, I do think, another common narrative for the low neutral rate earlier was safe asset demand, particularly coming out of the GFC. Right. And so I do think that that's something that could shift or could potentially, change and drive up the neutral rate. Certainly there was a lot of demand, a lot of asset creation after the GFC. There's a lot of demand for those assets, however, and it's not clear if that same demand is going to be there in this circumstance. And so I think that that is something that we're following.
On health.
Thank you. So this is not to put you on the spot, just to be very clear.
Go ahead.
It's a theoretical question. Somebody asked me the other day, how do you know that interest rates are sufficiently restrictive to return inflation to the objective? And then I realized I didn't have an answer. And since, you do this for a living, and in talking about forward guidance, part of the purpose of forward guidance is revealing the reaction function, and the reaction function at the end of the day is conveying how do we know that rates are sufficiently restrictive. How do you do it, if you want to share?
Okay, who's the first volunteer? Kartik, did I just see you grab your mic?
Only because I want to make it easier for my colleagues. It's a question that I think I also wrestle with. Let me answer it first from a more abstract point of view, the way I always think about neutral rates or R stars, in some sense, it's a construct of models that we might use to think about the world. Those models are, of course, not something that one can see directly. For clues empirically, I tend to focus on the extent to which inflation at any given point in time is well described. Let's say after stripping out, some things, not everything, you're left with prices, a large set of movements in prices not being relative price movements, not some things moving rapidly relative to other things. When I, speaking for myself, when I see that, it's essentially, to the extent that I accept this way of reasoning about inflation, it's a clue to me that says, no, right now is not actually restrictive. When I see broad-based movements in inflation, then I cannot easily ascribe to, oh, that thing went up like crazy and that's why we pick it up. So for me, this is a little bit of the recipe that I use to think about neutral. And then, of course, there's the battery of estimates that researchers use coming from the theoretical end, which I started with, but also going back to extremely empirical ends of the spectrum, where they're really essentially trend extraction kinds of exercises to figure out what's the lowest frequency thing that is what's happening to that component, for instance. If you take all of the above and keep them all in your head, I think it keeps you in a relatively safe space, given the amount of uncertainty there is about this. But that's the best I can do.
So relative versus general prices.
Yeah, that's how I think about that.
Yara?
So sort of very similar answer. I think that, everyone these days is really thinking hard about this question, especially because, as you mentioned, you have all these theoretical models, or empirical models to estimate R star. They're models. Even the definition of R star is actually not all, it can be controversial. And so that's even the starting point, is the short-term rate, yes, in the long run, in the absence of shocks, and is not really like the situation as of today. So it's this ideal world. And so the best that we can do, at least the way that I normally try to think about these issues, is to think about different state of the world, looking at all the variables that, it was mentioning, not just inflation, but also the labor market, the economy in general, and just see, where they are. If you continue to have imbalances, it's some kind of information that you're probably not quite there in terms of how restricted you need to be to bring things back. But this is really like the sort of framework that I try to have in the back of my mind when thinking about this issue.
Joe?
I'll just, along with both Kiara and Kartik, looking at prices, right? I think with inflation as high as it is, the argument on policy being restrictive really depends on your view on lags, and when those lags are going to have an impact. One of the things I've been thinking about, we think about lags, and there's kind of this mechanical aspect to the lag when debt rolls over, when interest rates start to go up. But there's also probably an endogenous component, to lags that relates back to Fed communications too, I think. And where do those lags come from? What determines the lags? I think there's still a lot of uncertainty around that. And so there could be just some time before the higher policy actually sinks into the decision-making in such a way that it's impactful on the economy. And a lot of different things can determine how long that's going to take.
Beat.
Yeah, thanks very much. You touched on that, but in terms of the banking stress we have seen and the kind of the credit tightening on the back of that, from a market perspective, we went from a situation where everybody was very worried and priced in cuts and so on, to a situation now where it almost feels like it's gone. Nobody talks very much about it anymore. So I'm just curious from your perspective. I mean, have you been, to what extent have you been surprised by anything in terms of maybe also from feedback from kind of the banks in your district? I mean, do you feel that what we are seeing in terms of any credit tightening is kind of fully in line what you would expect given where interest rates have gone? And this risk of any non-linear reaction has this come down a lot or so? How do you think around this banking-driven credit tightening? Thanks.
So I'm going to start with Chiara.
So I touched a little bit upon this, in the initial round, and I mean, I sort of agree with you in that, everyone was really focused on when this situation started, about trying to figure out what the consequences would be. I think that overall there is still a lot of uncertainty. If you look, it's an important issue because it's not just the fact that we need a stable financial system for an economy to thrive, but also given the situation with inflation and so on, we need to figure out how high rates need to be and restrictive conditions, in addition to monetary policy restriction, can deliver some additional kick to the job that our policymakers are doing. I think that people have sort of realized that the restriction is around like 25 to 50 basis points, in terms of Fed fund rate equivalent. My own staff has estimated something around 30 basis points. It's big, not extremely big, but it's something, in addition to the restriction. The one thing that I was a little bit surprised about was when I mentioned about the banking condition survey in our own district, the responses that we got were, we got a lot of tightening, especially from April to May, but the main reason was actually not the banking stress, it was monetary policy. And so, I mean, I hope that this partially answers your question. There is still a lot of uncertainty there, but I think that monetary policy tightening is still the main component out there in credit tightening.
Joe Karchik, you that.
That matches our survey results too, where we see the bigger impact from monetary policy tightening. So,
okay. So if my reading of the schedule is correct, we have a coffee break, and I'm sure everybody would love to talk with one another. So why don't we have a big round of applause for our guests and have some coffee.
Thank you, everyone. Oh, please do take your seats. We will have a panel where we will be focusing a little bit more on the central banking monetary policy toolkit, looking at inflation targets, and having a discussion. Some of you will have noticed that you have been moved around. I apologize. But we thought actually it's nicer to bring everybody in. We've kind of made it more of a circle. And filled in the spaces for those who are coming tomorrow or running a little bit late. So thanks so much for that understanding. So anyway, I am Ellie Groves. I'm the Managing Director for the Economic and Monetary Policy Institute at OMFIF. And once again, so grateful for you all to be joining us. Also, those who are listening online, very pleased that you can be taking part in this discussion. Everything will be recorded, as we said at the start, so we're very pleased to have everybody here. I am a big believer in audience interaction. So once my panelists have answered the questions that I have, I will be asking you all to kind of pop your name cards on the side and also ask your questions too. So do be thinking about those throughout as well. We have Christopher Neely here, who's Vice President at the Federal Reserve Bank of St. Louis. I'm very pleased to be able to ask you around the Fed's dual mandate, looking at how we are combating, how you and also the Fed and the wider central banking community is combating inflation. And then also we'll dive into a little bit about, you've written a bit about the unconventional monetary policy that we've seen over the last few years. So we'll be a little bit also in how that plays into what we're now seeing with QT. James Sweeney, Head of Economics at BlackRock. Excellent to have you here too. Thank you so much. I'll ask about the market views of the Fed's toolkit. And actually a question that came up in the last session, I'm going to ask around, do we have the right models? Are we on the right track? Are we looking at the right things? And then that brings me excellently onto Isabella Weber, who is Assistant Professor of Economics at the University of Massachusetts. I'm really pleased that you'll be able to give a little wider. I think you said earlier that you were sort of out of the box, and I like that. We can shake things up a little bit. That's looking around the overlapping emergencies that we are currently seeing. So that is enough of my voice, and I will go to you, Chris. Please, could you give a little bit of a flavor on the interpretation of the dual mandate for the Fed, its implications? We were talking around the title of this is Revising the Monetary Policy Toolkit. Do we need to be doing that? What is your kind of thoughts around how central banks are tackling the current issues?
Okay, so the disclaimer, as everyone who works at the Fed here knows, definitely applies to me. So what about the dual mandate? I guess I should say first that, you know, the dual mandate is one step above what any decision that anyone at the Fed makes. So the Fed is a creature of Congress. Congress decides on the dual mandate or whatever mandate they're going to give us, and then we try to fulfill the mandate as best we can. With respect to the dual mandate, so since I can't comment directly on the dual mandate, what I could do though is talk a little bit from an academic point of view about mandates in similar countries and what we might learn about mandates from those. So I knew that Ellie was going to ask me about mandates and frameworks. I don't want to mislead you into thinking that I did this, that I know this stuff off the top of my head. I did a little bit of research into the G10 mandates, and I looked them all up. And first I found that there are only 7 G10 mandates, as some of you have already figured out, because several countries are under the ECB. So the G10 mandates all include a mention of price stability or something very similar. And most of them include something about that sort of qualifies the mandate to obtain price stability and qualifies it in terms of being careful about the economic context in which price stability is achieved. And that's usually interpreted as perhaps a weak version of the maximum employment mandate. So an exception to that, however, is the Bank of Canada. The Bank of Canada's mandate, at least so far as I could see, doesn't say anything about real activity or a qualifier to that effect. Now, I could be mistaken. This was pretty cursory research. But I also found out that the Bank of Canada and the Canadian government did a review of their framework in 2021, and they looked at 4 options for the Bank of Canada's mandate. And one of the options was essentially a dual mandate along the lines of the Fed. And that was rejected in comparison to keeping their current mandate, which just means price stability. But I will say that although the rest of the G10 doesn't have a dual mandate in the same way that the Fed does, I do notice that central banks, all the economists and usually often the governors at central banks, they go to the same schools, they read the same papers, they get the same ideas to a large extent. They're hit by similar international shocks. And not surprisingly, central banks internationally behave similarly. And although I can't prove this, and I haven't done any research on it, my guess is it would be very difficult to distinguish the behavior of banks without a dual mandate or with some kind of weaker version of a dual mandate from the behavior of banks with no dual mandate at all, like the Bank of Canada, or banks with a dual mandate like the Federal Reserve.
Thank you very much. And I guess that actually brings us very nicely onto James. So looking from the perspective from the market, do you think that the Fed's dual mandate is the correct structure? And also a little bit on do we have the right models as well within the toolkit to be addressing that mandate effectively?
Thank you. Dual mandate is fine, I think, from a big picture perspective. To me, it makes sense. To target inflation and to have a labor market component. I think it's all in the implementation details and what will the Fed do? We're in a moment right now where there's considerable uncertainty in the market about what the Fed will do. There's not considerable uncertainty about the mandate. It's about how to achieve the mandate. We heard earlier that not much has changed since before the pandemic. To me, a lot has changed in monetary policy. One thing that's changed is we don't hear a lot of central bankers say that deflation is a bigger risk than inflation anymore, which was very often said before 2020 for many years. The reason for that was, I think, fear of the zero bound and this discomfort in use of balance sheet policies. And it was often said, a belief that we know how to conquer inflation when it breaks out. It's somewhat obvious. You can raise interest rates and slow the economy. But to me, it was always somewhat obvious that history suggests accomplishing that presents political economy challenges that are harder than they look, always. And so inflation is more frequent than deflation historically, and even cross-sectionally at almost every moment in time. So here we are, and the Fed are not targeting 2, they're targeting around 2, we heard today. So things are pretty interesting. And on those models, there's a lot of uncertainty. I'm not sure a version of the models that says it's all about labor market slack and core services inflation X housing is a model that we trust in terms of getting inflation back to target and following the employment mandate. There was just a paper by Bernanke and Blanchard last week suggesting that that maybe labor market slack has not had that big a role in the inflation problem so far during the pandemic, but it's likely to have an increasing role going forward. Like, this is actually a controversial idea, that the slack has been central, because we had low slack in 2019 and not much inflation. So again, some things have changed. I think the institutions in financial markets have changed. There are many businesses who believed the kind of really low R-star, deflation's a bigger risk than inflation story told by many economists and central banks before 2020, and have built their business models around that view. And now they're getting in trouble. And that's what's happened to some banks in the US. And if interest rates remain here or higher, it's likely that it will happen to more banks and to more institutions going forward. And whether the Fed can be patient with those problems and their ability to help inflation back to 2%, or else they need to do a little more, is a pretty major uncertainty that no model is going to resolve at this point. So just to kind of close my opening remarks, I think a lot has changed. I think models are good for giving someone a general sense of how monetary policy works, but not so good for answering important questions about what is next from the moment right now. And I think the big thing that's changed is the fear of deflation is less, and the institutions are a little different, and some balance sheets are a little more fragile than they seemed not that long ago. Thank you.
Thank you. I'm going to use my discretion as chair to actually ask you immediately a follow-up question. And this is one that has come when I was having conversations yesterday through New York with David Marsh as well. Should we be, and is there any scope, so as President Harker mentioned earlier, that they're looking for kind of the range of 2% inflation, even if that's slightly above. And one of the questions that kind of came out of that is, do we accept, and what are the implications of us accepting that actually 3% might be the correct inflationary level? Do you buy into that? And what is your thinking around if actually there is okay, we need to take stock, we need to work out actually, is 2% the correct target for inflation in our current demographics and our current structures in the current world that we are living in?
Yeah, well, I think there's a big difference between outcome and target. And I think changing the target from 2 to 3 or something like that would have significant implications in private sector expectations. And I think that would probably have some negative consequences. I think it may well be that you end up with 3% inflation for several more years, at least from here in certain states of the world. But meanwhile, there's a growing conversation in the market about the potential disinflationary impacts of new technologies like ChatGPT. So I think messing with the target is just going to create uncertainty. And I think it would erode some of the confidence in the Fed if that happened. But I think you can have a theme of patient return to 2%, which is not quite the same as changing your goalpost.
Thank you. And this brings us nicely on to Isabella. Be interesting to hear your perspectives around actually the times we're living in as overlapping emergencies. And are central banks set up, and also should they be alone in managing these challenges, and how do we build out this conversation to perhaps also looking at beyond central banks as well?
Yeah, thank you. So the way that I'm thinking about this current moment is indeed in terms of overlapping emergencies. We have had the pandemic, we have the war in Ukraine that kind of overlapped with the pandemic. And of course, we have climate change, where many climate scientists have been warning of tipping points happening much earlier than we might have thought. And these things have consequences, and they have consequences that tend to be very sectoral. So if we look at climate change and we look at things like the Mississippi River drying up, then this has a very immediate sectoral impact. Or if you look at Germany, where rivers have been drying up and coal couldn't be shipped, and that at least at the margin exacerbated the energy crisis. So if this is a situation where these kind of shocks have become more likely, we of course never know whether they are going to hit and when they're going to hit and how they're going to hit, but it seems like they have become somewhat more likely than they used to be in the era of the Great Moderation. And if I look at papers like the Bernanke-Blanchard paper that has already been mentioned, that suggests, among other things, that price shocks were actually one of the most important drivers of inflation, then I think this begs the question of what kind of price shocks have the potential to become systemically important, or in other words, what kind of prices are systemically significant for inflation overall. And this is a question that we have been trying to address in recent research using input-output modeling, where we basically shock every sector at a time and try to see what are the impacts on the general price level, looking at these indirect effects that come from our input-output model, as well as, of course, the direct effect that comes simply from the weight of the CPI. And we see that a small handful of sectors end up being considerably more important than all other sectors, in particular energy-intensive sectors such as chemicals, but also the bare necessities that President Carter was talking about earlier today, that is housing, food, and so on. So if this is the case, if there are specific sectors that have the potential to unleash overall monetary stability, then maybe we have to think about complementary tools where we can absorb shocks in these sectors more locally. And I think that the mobilization of the Strategic Petroleum Reserve in 2022 is a successful example of that. And if we had a mindset of doing this more systematically, then maybe the Strategic Petroleum Reserve would have been mobilized in a way where oil would have been bought up when prices were negative, would then have been released when oil prices started to climb, and thereby also sending strong signals to the market. So basically a form of open market operation for the oil sector as something that can be complementary to monetary policy and that can halt these kind of energy shocks before they ripple through the whole economy.
Thank you very much. James, I'm going to bring it back to you and actually ask you around the effectiveness of forward guidance. And do we think that, kind of building on that models question, and we'll go back to some of this, especially as we are in a time of a lot of volatility, as Isabella mentioned, we're coming into a climate crisis as well. And there are huge amounts that the policymakers have to consider, and also this high inflationary environment that comes from various different spaces, and geopolitics plays into this as well. Kind of my question is actually, if we're looking at central banks saying we're looking at the data, we're going to be really data focused every time we go into these meetings and look at our rate hikes, rather than forward guidance, we're looking at the data and we'll come to those conclusions each time. Do we have the correct data? It goes back to a little bit, do we have the correct models? But also, do we have the correct data? Are we comfortable that this is an area that we can keep on living in, and how do we go forward?
Well, I would just start by saying I don't think forward guidance is an alternative to looking at the data. I know that's not what you were suggesting, but I think forward guidance has its uses, right? And communicating to the market a likely path of policy is a way to guide the yield curve, which is useful for a policy perspective, whether you have great data or not, right? If the market believes it. So it's all about the credibility. I think I mean, we have a lot of data, right? I think the U.S. labor market is extraordinarily well covered by the data sets that exist. It's just hard to predict what's going to happen next. It's not that hard to tell what's happening in a moment in time, and notwithstanding, what was it, the quarterly labor market survey that came out a week or two ago that suggested that we had a contraction in jobs last year for a bunch of months. But I think, yeah, to me, these are two separate questions. I think forward guidance is useful as long as they're credible. I think we have plenty of data. The problem is the models and the natural uncertainty that exists given that data. I don't think either of these things resolve the challenges that the Fed has in front of them. I think it's, on top of all, it's really important to look at the institutions of the financial system and how it's shifting. I think the balance sheet right now is something that's getting not enough attention in regards to monetary policy. We've had some, statements about when is QT going to change. I think the Fed has a clear desire for interest rates to be the main tool, not the balance sheet. And yet it would be pretty strange if they continue to do QT and started to cut. When you have conversations about when could QT end, they do some weird things about looking at reserves or reserves plus RRP as a share of nominal GDP relative to certain events in money markets in recent years, which may not be especially relevant going forward. So to me, there are just many sources of uncertainties about how the institutions are changing, about how to interpret current data and the underlying parameterization in the economy and the correct models. And the Fed has to continue to kind of pursue its mandate given all this uncertainty, and that is a great task. It's best pursued with honesty about these uncertainties and not kind of simplifying some of the relationships.
Thank you. Christopher, moving a little bit on to actually where we've come from. So a few years ago, St. Louis very kindly hosted a conference that OMFIF put together looking at QE. It was something that was still being discussed. The consequences of QE were still unknown. We were in the middle of it. And now we've shifted to QT and all the other acronyms that go along with that. And I think that we're still living in the consequences of QE and having so much flow into central banks' balance sheets. So it'd be interesting to have a little bit of that conversation around the implications following years of unconventional monetary policy, and a little bit in which assets have been potentially been made unreflective or difference or created a difference within them.
So I'm not sure that I know of any assets whose prices would no longer be reflective of their underlying value because of QE or QT. Presumably, if the Fed went in and bought up enough of some particular class of assets, then that could create a condition in which it simply wasn't sufficiently traded to be functionally liquid in the market anymore. But I don't know that of any type time that's happened.
Yeah. Do you think that the knowledge, like that we know the consequence of QE currently, as in do we know, are we still living in a world where we are seeing the effects of QE play out?
So there's been a huge amount of research on QE and the accompanying policy tools, forward guidance, and tools that the United States hasn't used, but that other central banks have, such as negative interest rates. And there's been quite a lot of research on these tools. And I think that the short and simple story is that in the aftermath of the great financial crisis, these tools did work fairly effectively to provide substantial monetary stimulus. But we should also know that we should keep in mind that when we talk about monetary policy tools or economic policy tools in general, usually it's not a matter of they work or they don't work. It's a matter of, in this particular situation, in this circumstance, the way they were used, the way they were communicated, they did what they were supposed to do or not. So for example, in the case of forward guidance, there's forward guidance can be, one of several kinds, right? It can be Delphic, which means that the Fed is essentially making a prediction about the future. It can be Odyssean, which means that the Fed is, or any central bank, is committing itself to some course of action. And then there are various kinds of forward guidance too. So, I think forward guidance did work effectively to coordinate expectations on lower interest rates in the aftermath of the great financial crisis, but really only sometimes. It depended how it was done.
Thank you. That's a very good color there. Isabella, going back to you and looking at, again, how central banks have taken on this huge, how central banks have taken on the overlapping emergencies that we were talking about. And you mentioned earlier, so this might be a little bit of a side question, looking at the energy crisis. So you've been looking at the energy crisis as well. And so if you could give some color on where you think the next risk will come from, and will it come from us coming through the energy crisis?
Yeah, maybe on the energy crisis, I actually was serving the German government in the fall, working on gas price stabilization there, where there was a situation where there was a hope that the general macroeconomic environment, monetary policy and so on, would be enough to contain that energy price shock. And then this was, of course, the most extreme of the extreme situations. But came September, we were in a situation where it was simply no longer feasible for the economy to absorb the kind of gas price shock that we were facing. So Germany being, of course, an import-dependent country, unlike the US in the fossil fuel sector, the only tool that we had at hand really was a nonlinear pricing scheme that has been financed fiscally, where you have one share of consumption for households and firms that is price stabilized, and then you have another share at the margin of 20% for households, 30% for firms, where it's not price stabilized, so that you maintain the price signal where it can operate at the margin, but you do not shock households and firms in the part of consumption where they simply cannot adjust by having kind of a fiscal buffer to that kind of price shock. Now, this was, of course, a total extreme emergency that Germany was in, but I think these kind of policies can be helpful in these really extreme kind of emergencies. Now, looking forward, I think that, if I take the IEA warning about gas prices seriously, I think that there is a chance that gas prices will be unstable again. So I think especially in the energy sector, we are, of course, in a much better place, but I don't think we are out of the thick of it. If we are serious about a green transition, it's also the case that there will be volatility in that transition, I think. When there is a peak demand and you suddenly need fossil fuels, where fossil fuel supply has been starkly reduced, then that could also result in price spikes. I also think looking at global grain markets, looking at what is happening with grain in Ukraine, we see that the planting of grain has quite drastically been reduced. I've been talking to people in the grain trading business who are saying we are basically one extreme weather event away from another grain price shock. Now, grain price shocks are, of course, very problematic for food inflation, and food inflation is something that we have already been grappling with. And if in the US and countries like those in the European Union are really struggling with food price inflation, then countries in the global south are in real trouble, right? So I think that for the whole question of grain markets, which again is one that is heavily interacting with climate change, new forms of global stabilization are important. I'm not saying I have the solution. I think it's very complicated to come up with measures of stabilization because they have to take the realities of these markets into account. Of course, what we would be doing for grain would be different than what we would be doing for oil or for gas. But I think we have to start thinking about expanding the toolbox for these most essential goods to take out some of the volatility that we might be faced with.
Thank you very much. I want to move on to anyone around the table. I did say that I would be coming to you. So does anybody have a question or want to pick up on any of the discussion points or even a perspective themselves? I think that we are all here and we all have a lot to contribute for these discussions around where we think the monetary policy toolkit should sit and what we're looking at inflation. So also please do use this opportunity to kind of bring the perspective that you have as well. I'm keen on that. So George.
Yeah, I'm George O'Gay from Chesham Investments in Boston. Following the global financial crisis, there was some discussion as to whether the Fed should add a financial stability target to its mandate. And since that time, of course, we've had SVB and some other prominent bank failures. So I guess my question for the panelists is, what do you think of that notion, bearing in mind that the lean versus clean debate is one of the perennial debates in central banking? How should we think about asset prices and financial stability in the context of the central bank mandate?
James, you want to?
Sure. Well, I mean, supervision is part of the Fed's role. And I mean, sometimes it's not good enough in certain circumstances, but I, that's not part of the mandate, but that's part of the role of the Fed. I'm not sure the mandate needs to be redefined to include that. I will say one thing that a lot of people, a lot of investors are talking about now is R star star. It was bad enough that we had to talk about R star. Now we're talking about R star version 2 that gives us financial stability, and that's different. I mean, I think that's pretty painful, that discussion. And if financial stability or instability gets sufficiently severe, surely that's going to impact inflation. The financial system itself is always evolving and changing in response to regulation and technology and natural growth. And I think everything that happens in the economy is in some ways touched by how the financial system is functioning, and how it's functioning is different every 15 or 20 years. To me, the Fed and other official institutions simply need to keep some focus on those changes, understand those risks, and fulfill their supervisory mandate as well as their ordinary monetary policy role.
Chris, do you have anything to add?
Yeah, so, as you know, the classic debate in these circles is, do you use macroprudential tools, which may not be powerful enough to get into every crack and crevice of the financial system, and which may not quite do the job if you've got an emerging vulnerability? Or do you use monetary policy, which is sort of a blunt broadsword, and which also, if you're using monetary policy for financial stability, you're giving something up with respect to GDP and inflation. That's the classic debate, right? And it seems to me the usual answer back before the great financial crisis was, no, monetary policy sticks to monetary policy goals, and financial stability does as best it can with regulations and macroprudential tools. It seems to me that the probably, if monetary policy can have an effect on financial stability, and it probably can, then the optimal response probably isn't zero. You'd have to think about what it is, but probably zero isn't the right answer.
Isabella, do you have any thoughts on central banking role between monetary policy and financial stability?
Yeah, I mean, I guess the trade-off that has just been pointed to is a real one that we have been, in some sense, experiencing against in the last months in terms of the anxiety around the stability of the banking sector, which I think, again, kind of begs the question, if it is true that shocks have become more likely in the most systemically significant areas, and you have such shocks, and such shocks unleash inflation, you're in an environment where you have already pretty high interest rates and where you might have already a destabilized banking sector because you have been going through the kind of anxieties that we have been going through recently, then how do you respond to such shocks? And wouldn't it be a case where these trade-offs are becoming even more challenging than they might have been starting from a very, very low level of interest rates?
Thank you. David.
Yes, I had a couple of questions. One on this question, James, where you said one shouldn't change the target. I agree with you. It seems to me there's sufficient flexibility already, or you might say sufficient mud in the way that one defines various things in the central bank set of equations. So why bring in another precise variation to try to take account of the new set of circumstances? And I just wondered whether the panel believes that, say, the inflation targeting regime, which was brought in August 3 years ago, there's a question for you, Chris, and I brought this up briefly with you before the session started, whether that actually encompasses the new situation, because it was never made quite clear when that averaging was starting. And you could start if you started the averaging in about 2013, you could easily encompass a period of above average inflation in the next 2 or 3 years. So I just wondered whether the panelists could comment on that. And then the second question regards QE. And I was wondering whether in the United States, there's some feeling that people have departed from the labor force, people, particularly elderly people who are maybe sitting on assets which have gone up a great deal in value. People who had been in the labor force might then feel encouraged to leave the labor force because they feel they can rest now on a cushion of higher savings, thanks to higher equity prices, or indeed houses that have gone up in value. We seem to see some indication of that in the United Kingdom, elderly people leaving the labor force, partly because of QE. And I wondered whether you could see anything like that in America.
Thank you. Chris, do you want to take one or both, or?
Sure. How about if I do the first question? So just to restate David's question, David pointed out that from, say, 2012 to 2020, the Fed was consistently below its PCE inflation target. It averaged about 1.4%, if I remember correctly. And then in 2020, it adopted the flexible average inflation targeting framework, which said essentially if inflation is below the target, then we will allow inflation to run above the target for some time to make up for that. So I understand your point. They didn't put any numbers on that. I'm not sure that when they adopted the framework that they meant that they were referring to past inflation, but even if they were, my guess is that this is well above what they were thinking about. I suspect they're probably thinking about inflation in the neighborhood of 3% rather than, getting up to 7%.
Thank you. James.
Yeah, well, I think, one of the problems with average inflation targeting is it's sort of one of these policies that was constructed as if history started around 1993, 1994. Because if you go further back, you look at major wars and major shocks, there is such thing as like a war or a big shock that gives a price level shock where you have temporary inflation. You'd never go back to your old kind of price level trend, but you do get back to normal inflation. And the pandemic in many ways looks a lot like kind of World War I, World War II, those shocks where you had a temporary jump in the price level and then a path of normalization. We haven't normalized back to 2% inflation yet, but if you jump to a 3% inflation target, if that's coming from 2, you get the benefit of a short-term boom in nominal growth. If you're already above 3% inflation, going to 3% inflation target doesn't give you that transition benefit to the higher target. All it does is usher in a higher interest rate structure. So that's one of the reasons I don't like it. Just on the second question on the labor, I was just looking at this. If you look at labor force participation by kind of 5-year age bucket in the US, it's now really over 70, where you've had where you have a problem in participation. All the other cohorts are kind of reasonably close to pre-pandemic participation rates. But the issue is the share of the over 55s who are over 70 is rising really sharply. And the participation rates of all old people were rising very sharply before the pandemic. And now they're sort of sideways rather than rising sharply. So it is a worsening of the labor supply situation relative to what your expectations would have been before 2019. But there are some nuances to it which are really interesting.
Thank you. Isabel, do you have any perception on that labor force participation as well? But also it'd be interesting kind of looking wider than that. And also, do you see any demographic changes as well?
Well, I mean, I would just add that obviously we, as far as I can see, we don't have a very good picture yet what the effects of long COVID are and what part of the labor market issues that we are facing are also related to the fact that we have been living through a global pandemic. And when we talk about the stimulus, where some part of the stimulus also basically enabled people to maybe not go to work at a time when it was very dangerous to catch COVID in an unvaccinated situation, then I think we kind of also have to discount for that effect that might have been a positive on the labor market by not adding more labor market tightening than we could have had if people have had to go to work because they could not stay at home because they were supported during the worst period of the pandemic. So what I'm arguing is that I think on the labor market front, there is a nuance to be added to the question of the size of the stimulus.
Thank you. I also think it was interesting that President Harker brought up twice the childcare inflation as well, and actually that being a part of the labor force participation as well is definitely a piece of the puzzle, which is an interesting exploration there as well.
Yeah, and actually, I mean, we have seen that if you plot the childcare expense inflation, that this has been above trend for a long time, right? So this means that there has been a structural trend of childcare expenses going up and therefore really exerting pressure on the labor market. I think this is something that, again, is not an issue for monetary policy, but something that could be tackled with non-monetary policy and would actually be anti-inflationary.
And just to keep on kind of within that as well, looking at actually, do you think that that will have a larger demographic shift that actually underlines the inflationary pressures? So it makes inflation less transitory, not actually separate from supply and demand, or how we're used to looking at inflationary frameworks. Actually, if there is a demographic pressure, and with an older population especially, and how do you think that that will look for the future?
I mean, there is, of course, a demographic pressure, but I think the question is, how will it play out? I mean, it interacts with all these other things that we have already been talking about, right? It interacts with migration, it interacts with AI, it interacts also, I think, with how the global production network will be looking like. If we talk about onshoring and reshoring and friendshoring and so on, then this could be interacting with demographic pressure in a quite extraordinary kind of way. So I think we have to see the demographic changes in relationship to all these other trends, and rather than seeing them separately as one given structural variable that will inevitably lead to inflation.
What I'm hearing quite a lot today is that AI seems to be the silver bullet. So good job we're talking about that tomorrow and looking at technology, because it seems to be that that's gonna solve the inflationary problem. So looking forward to that discussion. Before we get there though, Angel, do you have a question?
Yeah. So following up on what Chris was saying, that average core PCE was 1.4% since the period when the 2% was established, right? And I guess the reason is because 2% was seen as a ceiling and not as a midpoint, de facto, if not de jure, right? And the reason I'm saying that is that all the projections of the FOMC at the end of the day had inflation converging from below to 2%, which is the way it's supposed to be if your target is 2. But what it does is that then it becomes a ceiling and not a midpoint. So how can we do 2% better if we don't want to increase the target, right? And one suggestion I've made in the past is that you run inflation close but above 2% during good times, under the assumption that in recessions it would be probably falling below 2. But that or any other suggestion that how should monetary, I mean, what is the lesson from that period, right? And obviously the lesson was distorted by the fact that we just got a massive price shock in the middle of it. But hoping that one day we'll go back to a more normal steady state, how should we do it in a better way?
So flexible average inflation targeting, I think, was motivated by some, may well be familiar, everybody may well be familiar with it, but motivated by some theoretical work that was done in, say, 2016 to 2018, where people essentially showed in a series of papers that if you've got an effective lower bound constraining the interest rate, that in reasonable models, you get a bias toward, and the central bank tries to hit 2% every period. What happens is when the interest rate is constrained by the effective lower bound, they don't hit 2%, they go lower than 2%. And so on average, you're gonna undershoot 2% in these models, right? And the way to get out of it in these models is for the central bank to tell the rest of the economy, look, when we hit the effective lower bound, yes, we're gonna undershoot 2%, but later we're gonna let inflation go up above 2%, and we're gonna keep it there a while. And if you do that, then not only that, in fact, keeps you from hitting the effective lower bound as often, it basically, it's a self-licking ice cream cone. I mean, it's just a wonderful tool that not only improves your performance when you hit the effective lower bound, but keeps you away from the effective lower bound. And so, it's really, if you take these economic models seriously, it's really hard to argue with the flexible average inflation targeting. I'm sorry, did that answer the question? Or I mean.
No, it does. But then how do you do it in practice?
Oh, I was going to say your rule, the UBIDE rule, maybe, sounds to me like flexible average inflation targeting, because you run inflation a little higher than 2% in good times, which comes after bad times, and then.
But then my projections say, imagine I were to design the SCP under my rule, inflation 2 years out would stay at 2.2 or 2.3 or 2.4 or whatever. It would not have to converge down to 2, right?
Okay, so that's a little different.
James, do you have a thought on the flexible?
Well, I think one way to frame it is for the Fed to say what they will fight, right? So at 1.7, around where we were a lot in core before 19, they would, you'd have an industrial production slowdown with a perfectly fine labor market, and they're fighting deflation with rounds of QE. That was odd to me, but there was a certain kind of worldview that got you there. At 2.7% core inflation 12 months from now, will they be fighting it? I don't know. But I think I think defining it not in terms of average inflation target, which is a kind of time period over which you calculate an average, which chains you to a certain behavior, or even defining it to a 2% point estimate. What about defining it in terms of this is the kind of world where we're going to be adding restriction or we're going to be adding ease?
Thank you very much. Do we have any other questions here, or any kind of wrap-up points that the panelists want to kind of put across? Any questions? If not, I think that we've got, oh, sorry, yeah, Michael.
So I was just wondering whether it might be worth distinguishing between, good and bad forms of excess inflation. I mean, if we really do transition from commodity and supply chain problems driving inflation to, labor market tightness that drives, inequality towards, historic lows and compresses, some of the spreads there. Do you think views on, what an acceptable inflation rate is, even if the Fed sticks with a 2% target, might shift over time?
James?
Oh, well, I mean, ultimately prices are supposed to be neutral in the long run. So you can have a transitory period of good inflation, but it really just comes down to your estimate of the potential growth rate of the economy and whether you're running above it and whether therefore the inflation is something that's going to cost you later. And I mean, there are major uncertainties about the potential growth rate of the economy, like at all times. So, unfortunately, I don't think there's an easy way to answer your question, and I think this is central to the challenge of conducting monetary policy.
Great. Taking on the challenge of conducting monetary policy.
So demand side inflation. So for instance, the classic story is that when the economy gets too, and I'm speaking very crudely here, when the economy gets too hot, then the Fed takes the punch bowl away, right? The reason that that story works, or the conditions under which it does work, is that the Fed provided too much punch in the first place. So, demand side inflation is a little bit like doing an all-nighter, binging caffeine to get your work done, right? You're really not doing yourself any good in the long run. It may feel good for a while, but you're not doing yourself any good. Supply side inflation is necessarily temporary and self-limited. Doesn't mean we shouldn't react to it at all. If my boss here, President Bullard, were here, he'd be swatting me on the head and reminding me that doesn't mean that we don't react to it at all. But it is different than demand side inflation, which is the classic take the punch bowl away before the party gets started.
Thank you. In true to form, we have now 2 more questions.
Yeah, I had a.
Oh,
sorry.
Yeah, we have one question over here, and then Vincent as well.
I'm okay. If we're tight on time, it was a question for Isabella. I'm really curious about your work on sort of complementary policy options, especially kind of historically speaking, to what degree there has been any impact on the real economy, if any at all. But if we're tight on time, I'm also happy to just take it offline.
No, we can answer that quickly, and then as quickly as we're able to, and then we can pick up the conversation. We've still got a little bit more time, so that's okay.
Yeah, thank you. Great question. Kind of related to what James said earlier on inflation targeting, and that maybe the inflation that we have seen is most similar to the inflation that happened after World War I and World War II. I think that actually these transitions from war to post-war are important points of historical reference. Because if we think about the transition from a shutdown to a post-shutdown economy, I think we are basically moving from one regulatory regime for the economy as a whole to another one, where in one situation, the state literally decided who can go to work and who cannot, and which factory can stay open and which cannot. And states around the world have been doing this in an asynchronous kind of fashion. So you did have pretty intense structural shifts. Now, what happened after World War I is that basically they had pretty intense price controls during the World War, right? And then they just pulled all these price controls at once, and they got pretty sharp inflation, so an inflationary boom that then made a sharp turnaround and turned into a deflationary bust. After World War II, American economists, including very conservative economists like Irving Fisher, including the most important textbook economists, Paul Samuelson, including the mentor of Milton Friedman, Frank Knight, and so on, were arguing that in this transitory moment, targeted price controls would be something that could be useful in facilitating this transition, because you have a situation where you have bottlenecks, prices shooting up without a supply response, because the supply cannot respond because there's a bottleneck. So the price signal basically cannot be operational in that kind of situation. Now, of course, at the time you had price controls, and the question was, are you going to lift all price controls or not? So in that sense, you were in a very different world from the world that we are living in today, right? Where obviously we do not have price controls for most things. And the question would be, are you imposing price controls? I think that price controls generally can only ever buy time. So if you're in an extreme situation of an extreme supply shock where prices inevitably are going to explode in ways where you do not get a supply response, and you are talking about something very important, you're not talking about the price shock in canoes in Western Massachusetts, where I was living, but you are talking about the price shock in gas and oil, or you are talking about the blocked port of LA that became the bottleneck of the bottlenecks for an import-dependent economy like the US, right? Then I think we can think about whether temporary constraints to the degree at which prices can increase, so not a fixed price ceiling, but the degree by which prices can increase, can be useful, which is basically what the price gouging laws are already doing at the state level for natural emergencies. I'm not saying this is like the magic weapon that you should pull at every moment, but in these situations of extreme shocks, of extreme supply constraints, I think they can play some role. But they will, of course, only be as good as the time that you have bought will be used. If you are kind of buying time and then you're doing nothing about correcting the supply shock that you have, then when you lift the price constraint, you will be in the same situation as before, and then prices will just shoot up a little bit later, right? But I think this is one of the lessons that we can take from the debates that the most important economists in the US had at this moment of transition. I think that if we look at China and we look at how China has, for example, been handling the grain price shock, then they have a gigantic reserve system, right? Which is probably larger than any rich country would want to maintain. I'm not saying that all of Europe and the US should be running these gigantic reserves. I think that would be absurd and would probably add to the grain price pressures. But thinking about possibilities where buffer stock could interact with markets in the sense of sending signals to markets, using market signaling via these kind of market participatory tools, I think is something that one can think about. I'm not saying it will immediately work. It's definitely very complicated. We also have many cases where these kind of policy tools did not work well, but I think it's something that we should be studying as we are trying to think about ways to buffer the kind of shocks that I think are unfortunately likely to reoccur.
Thank you. Nitin, we have.
Yeah, I had a quick question. I'd love to get your thoughts on the role of technology. We live in an interesting time now with EV space, definitely AI, blockchain, quantum that's emerging. It has direct impact on both labor and productivity. So I'd love to get your thoughts of how do you include that in this conversation, because it has a massive impact on what we're doing, both in terms of, again, availability of labor. AI already has sort of driven that whole movement in terms of especially knowledge workers with ChatGPT and everything else that's coming into the space. I'll pause here and get your thoughts.
Christopher, is it coming into your thinking?
Sure. So, there are a lot of factors that can potentially affect prices, technology, demographics, a lot of different factors. The only thing, ultimately, what's going to govern inflation, though, is monetary policy. Not necessarily in the short run. In the short run, certainly you can have supply factors, you can have supply shocks, wars, things like that, COVID. But in the longer run, AI is going to be good if it helps us produce more goods and services. Other things, like that, other improving technologies, they're good because they help us produce more goods and services, but they're not really going to affect inflation because any central bank can take those into account when it formulates monetary policy. And so the central bank can still determine the long run rate of inflation.
Thank you, James.
Yeah, well, I think it creates uncertainty about models. I think that can be true, what we just heard, but it can also be true that if you couldn't trust a potential growth estimate before, now you really can't trust a potential growth estimate. We heard earlier from the president about, do we think our statistics are capturing these effects? Do we think our productivity measurements are good? These issues are getting more severe rather than less with these new technologies. I think the thing that's very salient, though, about these is really on the relative price side. I feel like I've got relative prices and pure monetary policy, and I'm kind of sitting in the middle. And one of the interesting things about ChatGPT is we're coming out of decades where all of the shocks seem to be negative shocks of demand for lower skilled labor and positive shocks of demand for higher skilled labor. And you had a steepening of the labor income distribution related to that. And it feels like now technology may be about to start to do the opposite, which is really interesting and really important. I'm not so sure it's a monetary policy issue in the pure sense, but I think it probably will be somehow, because I think it's very important and we all need to think a lot about it.
Thank you very much. And we will come to a close now, because I want to thank the panelists. I want to thank you all for your questions, especially the ones that came in right at the end. We'll try and moderate that into the next session with Mark, which I'm very pleased to have with Fabio looking around tackling financial stability questions. So actually, I think a lot of what we've just spoken about towards the end there feeds very nicely into the challenges we currently see ourselves in. So thank you. Thanks, panelists.
You're not watching soccer results? Thank you. I'm delighted to be joined for this fireside chat by the fabulous Fabio Nattolucci, Deputy Director of the IMF's International Capital Markets Department, and the point person responsible for preparing the IMF's Global Financial Stability Report. Fabio, before joining the IMF, was a longtime member of the Federal Reserve and survived about a year at the US Treasury, if I recall. So
just because you weren't there.
So let me put a few questions to you, and then we'll take the audience questions. So I always think of the IMF's WEO as somewhat of a base case document, and the GFSR as exploring the WEO from the financing side and delving more into the tail risks. So obviously rates have substantially risen in the US and Europe. Economic activity is slowing somewhat. Warren Buffett said that one finds out who's been swimming naked when the tide goes out. We've seen some major bank stresses. So do you see the policy stance as restrictive? And what do you see as the major macro financial risks, and how concerned should we be or not?
So maybe I'll step back for a second and then get we think about financial stability risk and answer your question where risks are and whether it's sense of policy. The question I was asking before, like I'm free now to answer. So if you step back a few years, right? So we're coming from an environment where you had rates be close to zero, negative in fact in some jurisdictions around the world. You had very, very compressed volatility, and you have subdued inflation. And so that environment that lasts essentially since the GFC to pre-COVID set up an investment environment, if you want, where people went out searching for yield. So taking duration risk, credit risk, using financial leverage, and so on. So we are in a completely different world now because of a series of shocks in this polycrisis world. There was COVID, the war, and other shocks where inflation is stubbornly high, way higher than the target. And where policy has been, monetary policy has been tightened to try to bring inflation back to target. That, in some sense, has changed the macro backdrop, right, and the policy backdrop. And I think that's what we have been seeing, essentially, not just the case in the US with the banks, the SVB and the other banks, but if you step back, what we have seen in the UK in the fall of last year, in that case involved banks as well as pension funds. What we have seen in South Korea, for example, with Project Finance ABCP, that involves bank, non-bank, and any possible policy measure that people can think and have been thrown to the system, as well as here in the US, that is primarily in our regional bank issue has been. But in some sense, the thread is the same. You're moving from a ultra-loose policy environment where the investment thesis has been one where you just go out and get risk, to one where liquidity is being withdrawn through the federal fund rate in the US, or policy rates, as well as shrinking the balance sheet, including emerging markets. One thing that people forget often that there were 15 emerging market countries that actually, 18 if I remember correctly, they actually use asset purchases even in EMs, right? Which was a new thing. And so that, to me, that's the backdrop. And so the real question, I think the real policy question then is, is this just a painful process of normalizing policies, the size of the balance sheet, and coming back to a macro environment where inflation is going to be higher, maybe rates will be higher, which I think from a financial system perspective, financial stability may be actually healthy. Or this is like the canary in the coal mine, and then things are going to start breaking, right? So you see some tremors in the global financial system, and then at some point there's going to be a big earthquake. In some sense, what we saw in the UK, some of those tremors showed up in part of the global financial system that had nothing to do with the gilt market and the UK pension funds, right? We've heard and seen people that actually they had to close some position. They ended up selling CLOs in the US or some asset-backed securities in all the way to Australia, for example. So I think that's, to me, that's the big policy question. The system has been very resilient in the end. If you think again, all this series of shocks that we have seen from the banking stress now, the COVID, the war. And I think part is because you need to give credit where it deserves, which is the post-financial crisis reforms have really made at least the largest bank more resilient, right? So the G-SIBs of the world. Higher level, higher liquidity, resolution regimes, and so on. I think that's undeniable. We have also seen that a lot of risk has moved away from banks toward the non-bank financial sector. And so some of the risks may be there, and those are in some cases are more opaque. So we can have a discussion about vulnerabilities that link back to the banks. But I think the surprise here with the US was that the assumption, the operating assumption at least, was that if you make the GSIB safe, then the rest of the banking system will be safe as well. And I think we just learned that, first of all, there are banks that of size that is not too small, but large enough that if it's more than one, it can become systemic. Essentially, that a tail of the bank distribution can have systemic implication. And I don't think that was not how the system, from a resilience standpoint, post-GFC was designed, right? It was designed in a different way with other targets in mind. So that's, I think, a lesson to take from there. Maybe another lesson is that, and has been mentioned before here and there, that technology has played a role there, right? So if you think a bank that in essentially an afternoon can lose $42 billion deposit, and then at opening there were another 100 on the queue to go out, that's on the run side. But then you think the policy tools that are available. I worked at the discount window when I was at the board. I'm not sure how you would react to that speed, right? There's no discount window button on your iPhone that you push and you get the money at the window, right? There's some steps. It's designed for a different world. So that's another part I think need to be reconsidered too. So, but overall, if you think about all these shocks, I think the global economy and the global financial system have been quite resilient. I think it's fair to say that, in part because of the policy response that we have seen to COVID, as well as to the banking turmoil here in the US.
It should stay that way. Well, I think I just heard you say that the banks on the whole are resilient, especially the big ones. Some concerns about others. But I've recently even heard that European banks may be stronger than US banks, which startled me. But be that as a case, there are a lot of mark-to-market losses on banks' balance sheets and whatnot, even if they're holding until maturity. So is it really the case that the banks are still strong and resilient?
Okay, so everyone, us included, have done the exercise of taking the held to maturity portfolio and marking to market, right? So Treasury, MBS, anything you have there. If you do that, and you do not just the banks, but with the non-bank financial institution, the system melts. It's not designed to be instantaneous mark to market the entire fixed income portfolio, right? This is how the banking system works. I could argue that it's in fact, once the Fed facility, the bank term funding program is in place, I can't imagine a reason why you would want to actually mark to market your entire hold to maturity portfolio, right? You can always go to the Fed. Now, the argument is a different argument, which is going to the Fed is expensive. That if you go there, you pay 5% plus. And also that if you touch one piece of the hold to maturity portfolio, you need to mark the entire portfolio. So that's a different challenge, right? And I think that's in part what investors are pricing when you look at bank stocks, or particularly regional bank stocks, right? That there's a profitability business model problem. Because your liability side, you can't pay close to zero deposit. The deposit beta is going to go up. Money is getting out of some of those banks, and it's going to money funds and other alternatives. So your liability cost is going up quite a bit. If you want to survive, you need to increase that. And then on the asset side, you have either this held to maturity portfolio that you don't touch, you can't touch, or you have, particularly for the regional in the US, invested in sector like commercial real estate, with banks account for, regional banks account for 70–75% of bank lending to the CRE. And it's a sector that it's a confluence of possible things in some sense they are concerning now in terms of vulnerabilities, right? The role of regional banks, the role of non-bank financial institutions like, I don't know, the REITs and the valuation of REITs, private credit markets there, the CMBS market, participation of foreign investors. So there's a confluence of things that could, in some sense, pose a challenge. And so that's the structure of the banks, of the region, right? Both on the liability side, pressure, higher cost, funding costs, and then less profitability on the asset side, plus likely more regulation coming for them. So, and I think that's what is being discounted. You don't see similar stress for the larger banks. You don't see it here, you don't see it in Europe. It's not Roma, I can assure you. But in some sense, this issue of held to maturity, so we looked at that, right? We tried to mark to market and see what will happen to the entire distribution of banks. Our calculation was that for the US, about 9–10% of the distribution of banks will actually fall below regulatory capital, so will have a significant impact. We've done the same exercise for other advanced economies, for emerging markets. I think one difference across these groups is one that while the securities holdings, the fixed income portfolio is high, also in other jurisdictions, but the held to maturity portfolio is smaller in other jurisdictions, both advanced economies and emerging markets. Europeans have a different approach to interest rate risk through Basel III, so I think some of it might be accounted for. And then emerging markets have other advantages if you want. That the share of short-term debt is smaller, so they are not facing the same challenges. Of course, emerging markets are much more bank-centric. The average credit quality of the loan book is lower than advanced economies. So they have other issues, but if you look at the performance of emerging markets through all these shocks, including the last one, and you asked me 2 years ago at a conference like this, if the Fed hikes 500 basis points, what would happen to emerging markets? If you just look at the investment grade spreads for EMs, it's flat for the last 2 years. So the performance has been extraordinarily strong.
Great. You and I have talked a lot about non-bank financial intermediation over the years. And obviously, after the GFC, we were worried that by regulating the banks much more tightly, that the risks would gravitate to NBFIs. But still, it's the case that banks interact a lot with NBFIs. So excess leverage in this interaction, one would think, should be caught by the bank supervisors, but maybe in SVP's case, it wasn't. And then second, even if a major asset manager, you could argue, is an amalgam of lots and lots of funds, presumably there still can be a lot of interconnectedness among funds, and if the funds are similarly correlated, there isn't much diversification in practice. And then stress can be quickly amplified, which is a major focus of GFSR. So, I mean, the FSOC hasn't designated any asset managers as systemic. I mean, should large asset managers, either for their activities or as entities, be viewed as systemic, and what should be done?
Okay, so there's a lot of questions here. Let me step back because you answered a question about the stance of policy, and I'll link to this that I didn't answer before. I forgot, I got distracted by it. So in terms of like one of the reasons why inflation is not coming down, right, and policy has been tightened, I think Chair Powell answered one of these questions during one of the last press conference by looking at the ex-ante real interest rate, right? So you take the fair fund rate, you take away, I don't know, whatever measure, inflation swap, tips, whatever you want to use. Say 1 year ahead, and you say the fair fund rate 1 year from now, it's 300 basis point plus positive in real space. I think that's true, but with one caveat, that if you do if inflation surprises to the upside consistently for a number of months, as we have seen over the last year, say, that means that ex-ante you are 200 basis point positive, but exposed you are consistently negative in real space. And that's what we have seen, I think, for a while now. So if that's one-off, I think it's okay. If it's repeated as a risk that at some point the stance of policy is perceived as not being tight enough, And that generates a different kind of investment behavior. I think that's what you hear from people. It is true that it essentially boils down to the inflation outlook, right? If your inflation outlook is for a year or so consistently too positive, too benign, the ex-post policies to lose to bring inflation down. Another way to answer that question is if you take the 5-year TIPS real rate, for example, and you compare to some sort of whatever you think the equilibrium real rate, whether it's Laubach measures or whether this is, I don't know, the SCP, that number is above the long run, but it's not so much above than it was in previous historical episodes when inflation was much lower. And so by that measure, then perhaps policy is not tight enough. And that's why financial conditioning in the US, instead of tightening, have eased. And I think that's what fits into some of this concern of NBFIs, right? So the vulnerabilities that we have highlighted are primarily one of, say, duration risk, for example, credit risk, right? So we have few charts where, I don't know, life insurance, they have notably increased their share of risky assets over the last 10 years. Use of financial leverage by various NBFIs through derivatives, for example. But importantly, the point that you were making, or use of financial leverage, the financial leverage argument and the interconnectedness, right? And one of the reasons could be because maybe policy is not tight enough to actually squeeze some of these vulnerabilities. I think one caveat when we talk about NBFI, though, that we try to do in the chapter that we had, is NBFI is a very wide-ranging group of institutions, right? It includes relatively well-regulated institutions like insurance companies, pension funds, all the way down to family office, hedge funds, and others. And so when you look at this, they have different investment profiles, different time horizon, different vulnerabilities. So I think we need to be careful when we bucket them all together because the policy response would be the difference. Now, should be designated or not? I think the EPSOC did, then they de-designate, and there was a discussion about activity-based approach. I think I don't have intellectually an issue with the activity-based approach. The issue, it's more practical. The EPSOC is composed of 10+ agencies, some with financial stability mandates, some without, some with tools, some without tools. And for activities that cut across all of them, like leverage finance, for example, perhaps some institutions, some agencies do have a mandate and tools to slow that down, but others don't. And so when you cut across activities, you need to make sure that the agencies involved actually have the mandate and the tool to do that. Otherwise, I suspect and fear that the activity-based thing won't work. This issue of designating, regulating, whatever you want to use, I think it's crucial when you think about liquidity provision, though, right? So my personal view is that if you want to have access to the central bank balance sheet, whether this is emergency liquidity, even more important for standing liquidity, you need to be somehow within the regulatory perimeter. And it happens at some of these institutions or not. And so I think it's important to think of these issues now, that if you want to have emergency liquidity going to some of the institutions, you need to find a way to have data availability, to have a visual into their activities, and have at least some tools that belong usually to the regulatory authority.
Well, we'll save 13.3 discussions for another day. So on the NBFI front, there's been a lot of press reporting that about private credit surging, lending from private credit entities and PE, for example, and whatnot. Anyway, is this something that's big enough to be on the fund's radar screen?
So we worked and we looked into this more than once. For a couple of reasons. One is because it's a sector that's grown significantly, right? So if you define private credit here as private credit funds, say BDCs and middle market CLOs, the outstanding, if you include the dry powder, it's about 1.6 trillion based on our estimates at the end of last year. That means that the outstanding now is larger than high yield and leverage loan, institutional leverage loan. So it's a significant rise from 200 plus, say 10+ years ago to where they are now. So just the sheer size raised the question whether this is a systemic sector or not. They're also important source of credit and financial services, right? So they contribute to growth in a positive way, but they come with risk. So unfortunately, there are no data. So all what we have done is has been mostly on the qualitative side and going out and just gathering information, talking to people. And I've spent quite a bit of time in New York, for example, doing this. I think there are some risks ameliorant there. One of them is that there seems to be no run rates, right? These are committed capital for say 10 years. So this is not an open-ended mutual fund. You don't put money in and out. The bigger question was to what extent they use financial leverage. My understanding, again, based just on conversation with some of these guys, they show me what they do with numbers. They don't seem to use too much financial leverage. It's mostly collateralized leverage. It's not mark to market on a daily basis. So this is not like a total return swap. And it is collateralized. At some point, with some frequency, there is either you provide more equity or you provide more collateral or you shrink. I think the risk, though, is that because this leverage is provided entirely by banks, there's a risk that there is essentially an entry back on the bank's balance sheet from the back door. I think that's the main concern. And the third piece is this interconnected issue also in terms of cross-border, right? Some of these investors are not foreign investors, right? So you have the cross-border aspect, and I suspect some jurisdiction could have visual into their, say, I don't know, if you work at the Fed, presumably, at least my memory, you'd have some visual into what the large peer banks, who are you lending to, right? If you provide some of these like lines of credit to these guys, if I pick bank A, I should know. I don't know if there is a view from the other side, from the borrower side, how many that specific borrower, where is he borrowing from, and what is the overall size. But I'm quite certain that there is not much information in terms of cross-border, right? There is not enough sharing. That's what the FSB in principle have been trying to do for treasury since I was a treasurer and so on, trying to do. So my sense is that finally, the last point is, what is the concern then, right? If it's not necessarily financial stability, I think it's one of credit provision, right? So there's going to be, because it's grown so much into a credit cycle and business cycle that we have not seen, how the asset quality will perform if the economy slow down. And importantly, back to the question I was asked here before, whether that sector will be lessening the credit crunch, if you want to use the word, or you want to amplify the credit crunch, because they themselves will be shrinking future credit provision and make it more expensive. To me, that's the billion-dollar question, right? Will they essentially offset some of the tightening the banks are doing, or will they amplify what the banks are doing?
Okay, so I'm going to ask you a complicated last question and then go to the audience. So basically, it's about two facets of possible run dynamics. So, bank stress has resulted in a surge in money market fund usage. And these funds are heavily taking up the Fed's overnight reverse repo facility, which means there's less demand and liquidity for other private assets. That's the first one. The second, totally different, is concern about central bank digital currency. So at the first signs of stress, depositors might flee to CBDCs. And so it's no longer a world in which people line up at, like A Wonderful Life, where they line up at the bank. And what we saw in SVP's case was you could just run in a few seconds with your phones. So is that a huge blow on the future of CBDCs, or at least for wholesale CBDC, because I assume retails could be limited. Anyway, so there.
I'll start with the first one because perhaps can inform the answer on the second one. So when I was still at the board, I worked with Antoine on this issue on IRP. So I'm actually curious to see if his views have changed. But to me, the issue there, so separating IRP as a monetary policy tool, right? That's one issue, right? And I think in that sense, it's been quite successful. They've been able to hike the federal fund rate by 500 basis points, and the entire constellation of money market rates have come up more or less in sync. Whether that was meant to be temporary or is becoming permanent and has a permanent footprint in money market funds, that's another discussion. But from a purely monetary policy tool, I think it's fair to say that it's been very successful. The issue that we were discussing back then on financial stability was, and it couldn't be tested back then because there wasn't any bank run, whether during a bank run, the availability of access to essentially the Fed balance sheet, that would be an amplifier of the run. It would either incentivize the run or amplify the run. My view is that just putting numbers, right? So if you take during the month of March, there's been about, if I remember, it's 130 billion or so increase in our IRP. There have been $200 billion of deposit outflows and even larger increase into money funds. So clearly some money went out of the regional and smaller banks, went to money funds and got parked at the overnight IRP. Whether this amplified the run or not, I think that's becomes much more personal and judgmental. I don't think personally that you need to see actual flows for the actual availability of Fed balance sheet to become a vehicle for run, because it still provides a floor in terms of return, right? And so it still essentially allows money to get out of the banks and go over an RP or somewhere else, because that's a floor for money market rate. So from that standpoint, whether it goes there or somewhere else, it's still an amplifier, if you want. Should we expected a larger number of money going into an RP, given how much money went to money market funds? I don't know. I don't know the answer. To me, it's fair to say that if we learn something, it's that maybe having some circuit breaker there that could slow the run. If we think there is an issue, I think something that could be considered. I was in favor of considering back then. I remain in favor. Part of the discussion back then whether we should use price or quantity mechanism. I think the price mechanism, when your short-term rates is 5%, is not going to work unless you're willing to cut 200 basis points. I'm not sure the price will do much by itself, which I don't think they're willing to do. So when the level of rates are higher, just the sheer existence of that facility, you talk to a lot of people in the market, they will tell you that that's your opportunity cost in some sense. If you want to do anything, then I think it has to be done on the quantity side. Whether this is individual cap for institutions that they're lower, whether it's the aggregate or a mix of price and quantities with auctions where you fix the aggregate and then auction out to the institution. I'm not sure, people can have different views. Now, what lesson that means for CBDCs? I think one of the lessons is that an alternative of access to central bank can become an amplifier. Obviously, there are differences, right? It's not obvious that CBDCs will offer an interest rate that goes up less much, right? And so then it becomes less attractive. Whether this is wholesale, retail, how much is available of access to the central bank or not, I think that would be an important design, right? How much is available and whether this receives an interest rate or not. But I think there is probably more work needs to be done to understand if and how much the ONRP accelerated the run.
I mean, in a run, if people can run the CBDCs, they're going to run. They're not going to worry about the cost.
But that means that the 5% it's even better. It's an additional. I mean, the difference is that this needs to be intermediated by money funds now, right? And the CBDCs you have straight access depending how you design it.
Questions, Antoine? Do you want to comment on your former colleagues' views?
I think I agree with everything he said.
That never happens. What happened?
James. Negative or positive seniorage from this. But how should a central bank communicate its balance sheet strategy over time across periods, given the existence of this carry trade that can solve lots of problems tool? Like in particular, should there be a target of that thing size, or should it just be inherently something that exists and is a bit like the international swaps? We could use them as needed. They could be as big as needed. Don't ask about it. Or should there be a target? How do you think about that?
So I think there is one piece. Often the discussion is about Fed communication, forward guidance, whether you should what to make out of the SEP, the dots, and whether you forecast for inflation or be more data dependent. The part in my personal view that has been missing in terms of monetary policy communication has been balance sheet policy communication. In some sense, has been used for QE, has been used for financial stability purposes, this separation principle thing. It took several months to shrink a little, and then you get SBB and the balance sheet jumps, but those are different kind of reserve. Having a framework and a communication, I think, would be very helpful in terms of communication of the overall stance of policy. It was decided not to do that implicitly by setting on autopilot, right? So it's going to shrink. I'm going to tell you how we do it over a number of periods of years, and this is how it's done. I do still think that having clarity on the objective of using balance sheets, even separating monetary policy from financial stability, under what conditions should be used, what is the exit point, what is the mapping between balance sheet policies and federal fund rate policy. I think that would bring some clarity, I think, into market, because some of the discussion that people are having in terms of QT was the impact of QT. I think that we would certainly benefit from clarity from the central banks on how they look at balance sheet. There is a composition effect too, right? There's the straight balance sheet in terms of asset purchases, and then there's the asset purchase, either asset purchase that they did in March 2020 or the facilities that have been set up now. Those are different sort of reserve. But personally, I think they will certainly benefit. The big question is going to be the question you asked, right? There is a currency component that is going to go on its own, and then there is what is the buffer where you're going to get to if you want to maintain this like large ample reserve system. What is the buffer that banks need? That buffer is going to be probably endogenous to the conditioning markets as well, right? How much liquidity you want to take, precautionary liquidity on top of this of the regulatory stuff. The September 19 experience, that number, it's hard to gauge in some sense, right? Not only it matters at the aggregate for the overall banking system, but also matter in terms of distribution within the banking system, right? If the large banks have it, but the smaller one don't have it, you can still have an impact on money market rates. That's what we've seen in in September. That's the big question. I think that's why I think some communication in terms of, again, objective tools, how you use it for what purposes, how you exit. I think that would be beneficial in terms of transparency and in terms of like understanding the reaction function of the central bank. That part right now is left on autopilot and left guessing in some sense of what would be.
Okay, I'm just going to pose one last question, and then we're all going to go relax and have drinks and have fun. Since the G in GFSR stands for global, you could probably spend an hour talking about this question, but let me give you 2 to 3 minutes about it. So China, local government financing vehicles, weak state-owned commercial banks, housing woes. This could have, if there were big financial stresses in China that pushed the growth rate down or created financial havoc, that could have big global spillovers. I presume you look at this quite closely in your GFSR. So just anything, good headlines for us on this?
Yeah, so we had a box in October of 2021, if I remember correctly, in which we're trying to map possible contagion channels, right? So starting with the property developers, how that fragility there affect the macro housing sector in terms of house prices, in terms of sales, and what would be the impact for both banks, right? Who's holding some of those mortgages, who's holding exposure to the property developers themselves, holdings of the NBFI, the Chinese version of NBFI, so the wealth management product, they hold a bunch of this, and we have seen when they sell, they can have a major impact. And also then link back to the local government, right? So local government revenue source come mostly from land sales, and so when land prices are collapsing, house prices are moving down, has a huge impact on the local finance. And there was a tight correlation between the financial position of some of the region, the weakness in the housing sector, that would become self-reinforcing. I think the part that it's more, and so some of it has played out that we are in that box. What we have seen lately that I think was more concerning is that we're starting to see some pressure in the local finance government vehicles. At a time when the local government have been asked to try to complete some of those housing projects that were not finished. So putting more financial pressure on the finances of those regions, and you start to showing up in some of these local funding, local vehicles. I think that's in some sense is the next steps of the contagion. Obviously, they have the tools to address this. The issue is, this is not liquidity anymore at some point, right? It becomes solvency. And when it's solvency, there is nothing the government can do to make solvency issues go away. It's a matter of losses on to which balance sheet they get allocated. Yeah, whether it's the government, the large bank, the local government banks, the household, solvency doesn't go away. It's not liquidity.
So I was wrong. Emmanuel, I didn't see your flag up. I apologize. You have a quick, you get the last word.
Just a question, and I know I'm taking time on David, so I'm going to be short and eventually go through this during dinner because that's a long question eventually, or a long answer. is.
Thankfully, I'm picking up a training. I'm having a training like an hour.
Oh, you have plenty.
But I think, so you mentioned that in terms of financial stability, everything went well with the GSIBs. And what we see in the stress was mainly around the smaller bank area. But what we saw as well during this small tension, I won't call that a crisis, tension on the regional banks, what a flight to quality, was you cannot always fly to quality, which means also in this area, fly to GSIBs banks. And they became even bigger. I think they were having positive inflows where the regional banks were having outflows. And now we're going back to this 2006, 2007 situation where too big to fail, they are bigger than ever. So we have those top tier banks, JP Morgan, Bank of America, and the European ones, but everyone know them, become even bigger, and UBS, Credit Suisse cause a real issue in Switzerland as being really the massive GDP elephant in the room now in Switzerland. And to me, raise the question, are we solving the moral hazard issue, or are we actually pushing the cursor and the pitch further away? And what's next in terms of regulation to deal with this issue? Where is the agent principle issue managed in this area?
So the fund does, Mark knows this well, the financial sector assessment program. So if you go back and look the IMF FSUP for the US 2020 and for Switzerland in 2019, some of the issues that we had flagged are related to exactly this issue. So for the US, some of the concerns that were raised was about the, I forgot what word we used, but essentially the 2018 law in terms of tailoring and some of the possible consequences in terms of not only on the regulatory side, but also the possible implication for the supervisory posture that would trickle down from there. Similarly for Switzerland, some of the issues were around the resolution regime, availability of resources, and how that was set up and how it would be conducted if it doesn't need to. Some of those issues have been flagged. To me, it's the bigger, if I had to pick one issue that I would be concerned, is the issue of the resolution regime, in the sense that has been essentially used in one case, and then for one reason or the other, never used in different jurisdictions, in Europe, in other countries. So the problem is that a big part of the building block of the post-GFC regulatory agenda was exactly starting from a resolution regime. So if you take that away, because for one reason or the other it's not being used, one, it's been very costly for larger banks, right, in terms of burden of resources. But if you also don't use, you miss an important part of the entire building that's been built up post-GFC. And I think that's something that we'll have to be, as a community, both the supervisory, the international community, think about what the implications are, right? Because if that system doesn't work, then we have a bunch of other issues, including moral hazard being one of them. I don't think moral hazard discussion during the middle of turmoil is the right time to do it. That's not when you want to have that discussion. But once you get out of this among the various postmortem, I think that's going to be one of those. Is the setup for resolution regime done in a way that actually will be used, can be used, needs to be modified, and so on? I think that's a discussion that, again, in Basel and other places will have to be considered.
I think another question for another day is what this means for the future of deposit insurance regimes. Thank you everybody for joining us today. I think we're back here at 9 to 9:30 tomorrow, and we'll start formally at 9:30. Ellie, do you have any remarks on this?
No, just that's correct. We'll be starting at 9:30. So like 9:30.
We'll have coffee, etc.
Yeah, there's coffee, and then David will close us out.
Great. All right. Well, big round of applause for Fabio. Thanks everybody for joining us. And how's Roma?